Really, what's happened in the bond market is it looks like the market got ahead of itself.
We had that stronger January jobs number, which I think is what really kicked off this readjustment in market expectations.
You look at what the Fed is just continuing to tell us, data dependency, and we are watching that data.
The data can switch quite rapidly, which in turn can have a rapid effect on financial conditions.
At least on the rate side, we really haven't broken enough yet to do the damage that everybody thinks.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
Live from New York City this morning. Good morning, good morning. For our audience worldwide, this is Bloomberg Surveillance alongside Lisa Abramowicz together with Annmarie Hordern. I'm Jonathan Ferro. Your equity market on the S&P 500 down yesterday just a touch, down this morning by 1/3%. You know the data over the last few weeks, CPI, upside surprise, PPI, upside surprise, PCE, Lisa, coming a little later.
Yeah, 2.5 hours away, and a lot of people are saying that's the big data point. But how do you really trade it in a market that seems to be driven by its own sentiment right now? And that seems to be what the lack of conviction that I've read in all of the notes overnight. I have to say, Stuart Kaiser had the headline of the day, frankly. Is Momo FOMO or ONO? And talked about potentially shorting small caps if PCE is surprised.
You can translate that later in the programme, but ultimately, over the last few weeks, the last 2 months, this market has repriced aggressively what it thinks the Fed is going to do so far this year, and the Fed hasn't had to adjust at all. President Williams sounds like the President Williams we heard about a month ago.
Basically, 3 times seems about right for Fed rate cuts this year. They haven't changed their message. The market, kicking and screaming, came along to their view. But here's the real question. Is the market consistently pricing in a much slower path of rate cuts right now? Are we consistently pricing in still a complete nirvana soft landing?
Yep.
Or are people starting to think about what it means if an economy is not slowing down with 5.5% benchmark rates?
I can tell you the message has changed in Washington, D.C. There was a man back in the 1990s who once said, it's the economy, stupid. Well, it's not the 1990s anymore, and it's not just about the economy, stupid. Immigration is coming up as the big concern in swing states. AMH, in 2024, every state is a border state.
Well, exactly, but you're seeing pressure even from blue states on this White House to do more when it comes to the southern border. President Biden will be at the southern border today, as well as former President Donald Trump. Both are trying to also lean into this because look at this right now. Our poll shows more respondents are starting to track immigration as their top issue. Still, the economy remains front and center, but immigration is going to be one that they really need to grapple with. 1 point on the economy from our poll. Perception of the economy has actually done better. 31% of swing state voters say the national economy is heading in the right direction. That is up from our previous polls. The big problem is they're not giving the president credit for how they are feeling about the prospects of the economy, even if they think it's getting better.
Are they going to be at the same place at the border?
No, 300 miles apart.
They're going to be, okay, that's very
Well, it's
specific.
going to be 2 Secret Service. I mean, you know, if you look at how presidents travel, we're lucky they're going to be far apart for a lot of reasons.
I mean, honestly, the reason why I ask is just because I wonder how far apart their messages are going to be, or whether they're going to ultimately be the same message, just couched in very different language.
The interesting thing about our poll this morning is the issue of age, and we could talk about this a little bit later. 82% say that Biden is too old, 51% say that Trump is too old. That's a 4-year age gap that needs to explain somehow a 30-point spread between the two things. It's pretty amazing.
You know, we can get into this, and we can get into this with respect to the doctor's notes that we got from President Biden as well, which basically said not a lot and placated absolutely no one. And there's this real question here about whether it's just visibility, about whether we're just seeing Biden much more than we're seeing Trump, and whether Trump is more energized, or whether there actually is some sort of cognitive differential that people are trying to get their hands around. I can't weigh in on that, but there is a perception gap that Biden has to climb.
I find it interesting that President Biden yesterday was at Walter Reed. His physician said he's fit for duty, robust, 81-year-old. Yet, when you heard from the special counsel report, they said he was an older man. So it felt like this physician was almost pushing back on the special counsel report. And whether it's foreign policy, the southern border, the economy, this is going to be the trickiest for the campaign to overcome.
I hope that I'm going to be a robust 81-year-old as well, don't you? Equity futures on the S&P 500 negative here by 0.25%. Here's the stage. This is how we're set up. Going into that PCE data a little bit later on this morning, we're down 0.25% on the S&P. Yields are higher by 4 basis points on a 10-year, 4.30 on a 10-year this morning, 4.30.53. And the euro doing not a whole lot, 108.39 on euro dollar. Coming up this hour, Marvin Lowe of State Street as US stocks and Treasury yields ease ahead of today's inflation data. John Lieber of Eurasia Group as President Biden and Donald Trump hold dueling events at the southern border. And US Trade Representative Catherine Tai on tensions between the world's two largest economies. We begin with our top story, the US stock rally on pause ahead of core PCE data due at 8:30 a.m. Marvin Lowe of State Street warning we could be in a higher for longer world, saying, quote, if a no landing is the case, the Fed should be addressing a structurally different economy and investors need to consider higher term premiums and higher long yields than what prevailed before the pandemic. Marvin Lowe joins us now for more. Marvin, before we jump deep into that, let's just talk about what you're expecting at 8:30 Eastern time.
Yeah, sure. I mean, the numbers certainly going to move in a different direction than what we saw at the end of last year. For the most part, PCE is a combination of PPI and CPI, so it's going to come in somewhere in that hot spot 3 to spot 4 type of number. The market's priced it, but it's really going to resolve nothing in terms of those that think that we're going to be potentially facing inflation concerns as we go into the summer, to those thinking that it's just a one data point type of blip. So we're not really going to solve anything. We're not really going to break through many of the ranges that we've been in for really the last 6 weeks at this point.
Marvin, there was a big disconnect to start the year between what the market was priced for and what was implied in the Fed's dot plot and what they were looking to do in 2024. We've closed that gap aggressively in the last 2 months. What's the big disconnect that you've got your eye on right now?
Yeah, I mean, the big disconnect at this point still is that once we start cutting, we're going to cut aggressively towards a normalized world that looks a bit like it did before the pandemic. Ultimately, a neutral rate somewhere around 2.5%, and this glide to disinflation, whether it's on the services side of things and certainly on the goods side of things, which has been deflation, is going to reestablish itself at least at the second half of the year. There is a sanguine view that rate cuts, once they begin, are going to just continue in earnest because things are returning back to normal.
Okay, Marvin, all of this is very confusing and difficult. Add in a complete lack of trust in the actual data, right? I mean, yesterday, what was this coming out from the U.S. Labor Department, the story that Bloomberg broke about these letters sent to super users of the data, basically having this: the waits for single-family detached homes increased materially from December 2023 to January 2024. Nothing else is going to be said. Go on. And then they tried to retract it. What does this mean to you?
So I'm not a super user. I didn't get that. I didn't get that email. So I read it from Bloomberg myself. Probably the most contentious number within CPI is this owner-occupied number. It's an attempt to try to figure out what inflation is for those of us that own a home. There was a change in the weights between single family and multifamily, with multifamily being under more pressure, and all of us that watch the single family world or are trying to buy a house realize that inflation hasn't come down. We've always struggled with how to interpret that number. What this says to me is that you've got this bifurcation within just how to calculate it. That's not changing because the housing market still remains high. If that confusion continues out there, that inflation confusion is going to remain out there. And ultimately, we price CPI based on this very heavy weight. It should argue that we get more inflation volatility, which really, if you expect inflation to guide down to this really stable type of number, it might be a little bit optimistic.
Given that, you talk about a world in which 5.5% is not a restrictive rate and the potential for that, which is something that very few people are thinking about. How much likelier is that right now than it was, say, 6 months ago, in your view?
You know what? It was always out there. It was whether or not you wanted to go down that thought process. The goods deflation that we saw in the second half of the year, maybe the fourth quarter, made everything look great. But we always knew that that services number, which is the biggest part of the economy, wasn't responding as aggressively. We've got some decent prints coming out of ECI, but overall service inflation remains fairly high. And we've got a disconnect between what the jobs numbers are saying, the official monthly numbers, which continue to look pretty robust, as well as these weekly numbers, and the view that all of a sudden the jobs market is going to get right-sized. So within the next, 3 to 6 months, we're going to get a sense of really how much of the structural change in the employment market has a long-lasting effect, and whether or not we've got to think about higher yield, more inflation, volatility, more term premium, because the economy could be very different where it is now than where it was back in 2019.
Marvin, is that the case? If that's the case in the future, what would you do with equities right now?
Yeah, you know what? I've said it often, despite kind of the duration argument. Growth in an economy that's for the most part aging is going to be a very attractive part of your portfolio. So those Mag 7s do have a moat that they can defend. But cash flow positive companies are something that wind up being somewhat attractive if yields ultimately remain higher.
Does this mean that basically the government bond market is a no-go, and if you want to hedge, just go to Bitcoin?
I'm certainly not a Bitcoin fanboy, so I'll leave that one out there. The treasuries continue to have volatility, particularly in long end in my mind. You play it from a hedge perspective. We talk to customers about curve trades and things like that. Looking at 2s 5s maybe rather than 2s 10s. It's that type of nuanced world for me right now.
That's how you dodge the Bitcoin chat. Marvin, thank you. Marvin Lowe of State Street. Appreciate it. We can talk about Bitcoin. The inflows into the BlackRock ETF have been absolutely phenomenal. I think it was $520 million the other day, which was a record.
And we heard yesterday fund managers saying that the way that they hedge is with cash and Bitcoin, and that's why you're seeing it surge to new records. I do want to point out there was this small little story on the Bloomberg yesterday talking about how leverage in crypto assets is surging again, including in NFTs, including in Bitcoin. So, it's, I don't know, deja vu all over again.
We're doing the NFT thing all over again, just short of 63K on Bitcoin. Plenty of Bitcoin checks through this morning. Maybe
really?
A few. 2, 1 more, I don't know. Let's get you an update on stories elsewhere this morning. Here's your Bloomberg Brief with Danny Berger. Hey, Danny.
Hey, John. An Illinois judge has barred Donald Trump from appearing on the primary ballot. It's the third state to impose the ban for Trump's role in the January 6th insurrection. Trump now has until Friday to appeal, and he's already appealing a similar Colorado ruling before the U.S. Supreme Court. Weight Watchers shares are falling a lot. 23%. Oprah Winfrey said she would leave the company's board if shares continue to fall. The stock is set to hit its lowest level on record. Winfrey's departure is just the latest blow. Weight Watchers is trying to stay relevant in the Ozempic era. The influential talk show host says she will continue to work with the company in, quote, elevating the conversation around obesity. She served on the board since she struck a deal with Weight Watchers in 2015. Shares of Paramount, on the other hand, are rising 4.25% in the pre-market. The company predicted, quote, significant earnings growth this year that helped investors overlook a 6% sales drop as a result of shrinking ad revenue on traditional TV channels. The company also saw subscriber growth beat estimates on its Paramount Plus streaming service, which it expects to be profitable, at least domestically, next year. And that's your Bloomberg Brief. John.
Hey, Danny, thank you. Up next on this program, Biden and Trump's border showdown.
Donald Trump. He'd rather weaponize this issue than actually solve it.
With 4 more years of Biden, the hordes of illegal aliens stampeding across our borders will exceed 40 to 50 million people.
That conversation up next, live from New York City this morning. Good morning. Inflation data just around the corner. Equities pulling back by 0.2% on the S&P 500. Treasury's a little softer. Yields a bit higher at 4 basis points. On a 10-year, 430.73. Under surveillance this morning, Biden and Trump's border showdown.
All indications are this bill won't even move forward to the Senate floor. Why? A simple reason. Donald Trump. He'd rather weaponize this issue than actually solve it.
With 4 more years of Biden, the hordes of illegal aliens stampeding across our borders will exceed 40 to 50 million people. Medicare, Social Security, health care, and public education will buckle and collapse.
Here's the latest this morning. President Biden and Donald Trump hitting the campaign trail, planning dueling trips to the US-Mexico border. Immigration gaining ground on the economy as a top issue in the latest Bloomberg Morning Consult poll. Meanwhile, Trump maintaining his lead over Biden across all 7 swing states. John Lieber of Eurasia Group and former policy advisor to Senator Mitch McConnell joins us now for more. John, wonderful to hear from you, sir. It always is. Can you frame for us how different these addresses might be a little bit later today from these two leaders?
Well, you just saw a great preview of it. I mean, Trump's talking about tens of millions of people coming across the southern border, not a particularly realistic number. But Biden's on the defensive here, and this is a huge issue in the campaign this year. And migration numbers have been very bad under his watch from the perspective of people coming over the border. And I think he's going to be on the defensive the entire year. Plus, he's got to worry about this continued split in his own coalition from some Democrats who think the Republican approach is inhumane, and independent voters who want to see the U.S. government do something about the flow of illegal migrants. So this is a huge opportunity for President Trump, former President Trump. It's one of the reasons he won in 2016. And if Biden can't change the narrative here, he's going to be in even more trouble than he is today.
Well, to change the narrative, he might use an executive order. We know the White House was weighing this. Do you think before the election they will come out with some sort of executive order on the border?
Yeah, I think they're going to have to. I don't know how they don't. I mean, one opportunity, the politics of an executive order are quite good. It doesn't necessarily do much to change what's actually happening on the ground. He's not going to do the kind of things that Trump did. It allows him to draw attention to what he just did in that clip, which is point out that Republicans had a chance to get a border deal and turned it down because of politics. So he's trying to flip the narrative by taking action, whether or not it's effective. Is something that's going to help him politically.
Well, our polling shows that respondents still think Biden is responsible for the border, but more people are starting to also lay blame on Republicans in Congress and the Trump administration. So do you think Biden has, between now and November, able to close that gap and put more of the blame on Republicans for tanking that border deal?
No, I think those are kind of inside baseball arguments, and inside baseball arguments just don't really land with voters that much. I mean, he's basically making a process case that, I had a bill and the Republicans stopped it. And, the incumbent president bears the blame for what's going on in the economy and in society. And he's going to have to bear that blame, even if Republicans do have a role in that.
You, of course, worked for Senator Mitch McConnell. Yesterday, he said he's backing down from his leadership position. The president came out with a very friendly, nice response about him, talking about their time that they've worked together, about American democracy based on elected representatives coming together, bridging their different points. Is this part of our politics over, seeing McConnell step aside?
Yeah, I mean, this is the passing of the torch to the next generation. And the next generation is a lot more aggressive, a lot more confrontational, and a lot less willing and able to get things done than retiring Senator, than Leader Mitch McConnell. And I think that's a real shame for the country, because McConnell's whole thing, his entire time in office, is how does he drive to put wins on the board and get to yes. And that is not an attitude you see among a younger generation of lawmakers who come to Washington either to start trouble or to make statements in order to help their own political ambitions. And McConnell's only ambition was to become leader and then start doing things for the American people. And I think that outlook is a really, unfortunately, outdated perspective.
John, from here until the end of the year, does Mitch McConnell have more or less power now that he's announced his departure date?
Yeah, I mean, I hate to say it, but I think that's the wrong question. I just don't think that there's anything going to be happening between here and the end of the year, right? McConnell's big accomplishment is going to be passing the Ukraine aid bill through the Senate. That's done already. Maybe, they'll get a government funding deal. They'll have to deal with shutting down the government again later this year. The Ukraine question is all on the shoulders of Speaker Mike Johnson. So, McConnell's announcement yesterday just recognizes the reality that 2024 is not going to be a particularly active year in the United States Congress.
The reason why I ask this is because some people are speculating what role the former President Trump is going to have in picking a new leader for the Senate. What's your view on that at a time where a lot of people are talking about the slew of Johns, different senators with the name John, that could potentially rise to the helm, who are not necessarily on the more extreme fringes?
Yeah, Trump's role here is going to be massive. I mean, if he's the president of the United States, if he's the president-elect of the United States in November of this year, he will select the next leader. He will be the most important person in the party. He will be the dominant leader in the party. If he's not, it's a very different situation. And that's where you probably see the dynamics among the Johns that you're talking about, who have been kind of vying to succeed McConnell for quite some time, playing out. But if Trump's in there, you can have a pretty broad range of outcomes. I mean, I think there's another generation of leaders, of potential leaders in the Senate who are not today in leadership positions, who are going to be vying to be Trump's person inside the United States Senate. And the range of outcomes here is quite wide. I don't think we have, it's really early to handicap the succession race.
John, forgive me because we've only got 4 minutes left with you, and this is quite a large question. But what is the ideology of the Republican Party under former President Donald Trump? What is it anymore?
I mean, this is a populist, conservative, right-wing movement that unified behind a quasi-personality cult of Donald Trump. I don't know how else you think about it. You know, the goal of the party is to win back the White House. The guy who's going to win back the White House is Donald Trump. He has pushed the party in very uncomfortable directions that basically most elected officials are now comfortable with. For example, the party's hard right, or I don't know what to call it, the party's populist turn against international trade. And that's who they are right now.
Not just international trade, against mergers and acquisitions. We used to kind of characterize the party as being somehow business friendly. We speak to some analysts now who suggest that maybe they're not. John, we spoke to Speaker McCarthy in the last month or so, and I tried to address this question with him, and he didn't really answer it, about whether his party has just left him behind. We caught up with Nikki Haley in the last month as well. I just got the same feeling that this isn't her party anymore. It's different, it's changed, and maybe it's not turning around anytime soon, which begs the question, John, when I speak to my friends, traditional conservatives, old school Republicans, they kind of want another party. What are the chances that we get one?
None. I mean, the U.S. system has built itself around two major political parties. There's a lot of kind of social science reasons for that, and there's structural reasons for that. It's very difficult for independent candidates to even get on the ballot. And third parties just don't have the, Coke versus Pepsi brand appeal of the Republicans and the Democrats. It's why there's no independent or third party governors in this country right now. So, the Republican Party's moving in a very populist direction on trade, on labor issues, on immigration. And that's who they're going to be for at least the next 5 to 10 years before a new leader comes along to force a new political realignment, which is not on the horizon right now.
John, forgive me for asking this, because I know over the years you've been close with Senator McConnell. Do you think it's a failure of leadership beyond former President Donald Trump that they weren't able to make their message, their policies that much more popular within the party and ultimately for the electorate as well?
Yeah, I mean, this is a democracy, and the voters ultimately decide what they want, and what they want is Donald Trump. And you can blame that on failure of messaging, but the fact of the matter is that the Republican commitment to international trade has had implications in communities across this country that have been pretty devastating. And I think that there are costs associated with a lot of the policies associated with the Bush years of the Republican Party, and those costs have come back now in the political system, and that's where we are.
John, appreciate that reflection, sir. Thanks for catching up with us. John Lieber there, of Eurasia Group. I think for the people who are hopeful that we get that third party, it's just not happening.
I'm glad you brought that up, though, because in our polling, RFK is starting to be now more well-known. He rates very popular, most so among conservatives and Republicans. And this was the numbers. Among the so-called double haters, the people who don't want to see Trump or Biden, his favorability rating has improved from 25% when we started this in October to 45%. So if he's on the ballot, he's going to be pulling from both of these candidates.
I think people in the middle just resent what's happening right now, because people who are centre-right feel like the extreme left is pushing them further right, a place they don't want to be. People centre-left feel like the people who are far-right are pushing them further left. It's a place they don't want to be. Seems to be the extremes of the two parties, Bramo, which are shaping the politics of this whole country.
Which is the reason why I'm curious about the money. I'm curious about where the money from businesses is really going to go at a time where no one's getting particularly excited for this particular election.
It's hard to get excited for a lot of people. And you see that in the polling, by the way, repeatedly. Coming up on this programme, would you believe it? Chinese equities, just looking at the CSI 300 on my screen right now, up by 9% this month. This month alone, for February. We're talking about that with Virginie Maisonneuve of Allianz. Up next. Stocks on the S&P 500, negative 0.25%. The big data point, PCE, about 2 hours away. Going into it, stocks pulling back by 0.2% on the Nasdaq 100. Some slight, subtle, mild outperformance on the Russell. The small caps up by 0.15. In the bond market, 2-year, 10-year, 30-year. The 2-year still in and around 470, 468. Yields picking up here across the curve going into this data. We're up by 4 basis points on a 2-year. Lisa, at 4 basis points on 10s.
The expectation is that it's likely to come in hot. And what I keep seeing is if it comes in at 0.3 to 0.4% month over month, this core PCE metric, that's not going to be good for the Fed. They are not going to like that. And that essentially in March is when it starts to get less noisy with the year-over-year comps, and it becomes a much more inflationary picture potentially if this pressure retains.
Hasn't been good news for the 2-year Treasury either. Let's put it that way. I mean, look at the low and look at the high. On the yield, 4.1% last month, the high, 470 earlier this month.
Are we seeing stocks wake up to that?
Nope.
Okay, so this is really my question. Why are they treading water right now? Is it just because no one can get particularly enthusiastic and all the stories have been told? Is it because people are actually short, or is it because nobody has any conviction whatsoever, so they're just going to basically sit there and go like this until they can figure out what more is happening?
Are they sleeping on higher rates, or are they wide awake to the reality of what got them here?
They're wide
better
awake.
Data?
Yeah, exactly. And better earnings, right? So that's really what seems to be driving everything that we're seeing with respect to the confidence in equities.
2-year 468. Let's finish on foreign exchange. Want to look at dollar yen. The charts that we close at 150 are below. 149.98. We have not had a close below 150, I think, in about 2 weeks. We're negative 0.5%. So what you see on the screen right now is a stronger Japanese yen off the back of some commentary from a BOJ board member who gave a subtle hint, with the emphasis on subtle, that maybe they'll move away and start hiking interest rates.
It's never too subtle to get excited about the potential for moving away from negative rates. This is the comment. The Bank of Japan's price target is, quote, finally coming into sight. All right, they're going to hike. They're going to hike in March, right? I mean, this is basically where the market goes with that kind of commentary based on the fact that they've been so tepid on any kind of guidance whatsoever.
Off the back of that, just a little bit of a break at 150, 149.99. I'm trying to inject a little bit of excitement here.
People are excited, but, you know, it's not translated.
We did Bitcoin a little bit earlier.
Super excited.
That rally's been phenomenal, amazing. Typically, you'd say the ETF news would be a Southern news event, and I know lots of people said that. That has not been a Southern news event at all.
Yeah, but I don't really even have an understanding of what this is. How much is this just that people don't have a diversifier because it's not bonds anymore? I mean, we heard that yesterday. I think Jonathan Stubbs was saying that, right?
Talks
that basically Bitcoin is one of his assets that are uncorrelated to the rest of the market. I don't know what they're correlated to, maybe leverage going up in this area. But to me, this sort of popped out of nowhere and seems to be on a freight train moving back to some of the hodls and other types of trading.
Nice. That train just went through station 63K on the screen right now. You like that? No. Under surveillance this morning, investors are waiting the Fed's preferred inflation gauge, core PCE, due out at 8:30. The dad jokes are terrible at the moment.
I love it.
I know, I'm sorry.
Keep going.
Bloomberg survey expecting the number to double from a month earlier to 0.4%, plus another look at the US consumer with personal income and spending data. Then 210K, the estimate for jobless claims. Fed speak also on deck throughout the day. We'll hear from Presidents Bostic, Goolsbee, Mester and Williams. Claims. I think claims are going to be super, super important, given how low claims have been over the last few weeks.
And how strange it is that we keep getting notices from different companies about layoffs. I mean, we've heard this from company after company, whether it's Bumble, whether it's some of the bigger companies that came out yesterday. We saw some issues with Salesforce. We're seeing something with respect to guidance from HP. You know, all of these companies are, and Snowflake we saw come in quite significantly. They're all of these companies that keep trimming jobs. Why are they not showing up in the numbers, and do we start to see that?
Sony, Macy's, it's across the board. The Conference Board data shows that actually consumers are now very concerned with the labor market more than they've have been. It was always about inflation. Now they're also worried about job prospects. So that's something that I think you're right, for jobless claims is important. Are we going to at some point see any cracks?
Andrew Hollenhorst of Citi suggesting that maybe claims have been a little bit misleading and taken our attention away from the weaknesses seeing elsewhere, specifically in retail sales. I'll share the quote with you all at home. Low initial jobless claims and previously stronger data support the consensus that for now activity is solid. We continue to see a soft landing as the least likely outcome and expect activity to weaken later this year. Next week's jobs report, 2 Fridays away, is a key test and we see downside risk.
Okay, I'm going to go on a rant. Everyone's saying, watch the data. Everyone says the data's going to tell us everything. And then they say the data's messy. It's wrong if it's weighting things differently. And, oh, yeah, it's completely misleading because you've got to look elsewhere at other data. It's just creates the frustration of why we're sort of hitting our heads against the wall every time we hear someone come out
We're
and
only
say it's all
30
about the
minutes
data.
in.
All right, carry on.
How riled up are you going to get? But I'm with you. Whenever they talk about data dependency, it would always wind me up, because the real question was, what data are you dependent on?
Totally.
Like, we're all sort of data dependent to some degree, but how much weight do you put on one data point versus the other? And they never seem to go into the detail of any of that.
No, and when they do, it's usually pretty vague and sort of, we'll see, we'll adjust, and guess what? We don't know.
If this is where Abramowicz at 6:35, I look forward to 8:30 when that data actually drops. Here's the latest from Congress. Congressional leaders striking a deal to avoid a government shutdown. The deal extends funding for some government agencies a week to March 8th. The second deadline to fund departments, including Defense and Homeland Security, now sits at March 22nd. Hardline Republicans already condemning the agreement, setting up another fight with Speaker Mike Johnson. Are we done here, AMH? Are we moving on?
No, it feels like perennial shutdowns. We're moving on from this potential shutdown, but they just set up more dates where we can shut down. This is the fourth time since October that they voted on, or they're about to vote on, another continuing resolution. The issue here is going to be more in the politics, because Speaker Johnson is already getting a ton of flack from the hard rights, saying we didn't want to see another continuing resolution. You promised us you wouldn't have a continuing resolution. Ralph Norman last night said it was an insult to the American people. But yeah, the government will remain open and people will get their checks.
You're not fired up about this one?
No, I'm not.
Didn't
I'm
think so.
sorry. So we'll leave that there.
Move on to this. The hits keep coming for Boeing. The Justice Department raising the possibility of criminal prosecution following last month's blowout aboard a Boeing 737 MAX jet. The probe stretching back to a deferred prosecution agreement after two fatal 737 MAX crashes back in 2021. The Alaska Air incident of January happened 2 days before the deal was set to expire. If prosecutors determine Boeing failed to comply, they could bring criminal charges, Lisa, against the company.
This is just more bad news, and we see the shares falling yet again. And this raises this question of what's going on at Boeing to really do a deep dive investigation into what went wrong culturally, and also what mishaps there were, what sort of oversights or negligence there was by some of their employees at a time where they're dealing with employee confidence, employee retention, all sorts of issues. I mean, it just sets up a whole number of questions that I'd like to ask Brooke Sutherland.
TK did a fantastic job of this when this story first broke. The cultural issues inside the company. What's changed? We've seen some personnel movement, but ultimately, you're going to look to the top of this company a lot more over the next few weeks and months.
Especially given some of the commentary. What do they say? That it was unclear safety requirements that they changed on a regular basis? That kind of confusion, not great.
The report commissioned by Congress that we got to look into talks about this, quote, disconnect between the factory floor and the C-suite. Brooke Sutherland has talked about this a lot of time. Issues that are going on the factory floor are not getting to the executives that are miles and miles away. And the FAA came out yesterday talking about some of this, but they stopped short of some of the harshest measures they could have had on Boeing, which would basically mean halting the production of 737s overnight. But this is a huge headache for not just Boeing, but also the FAA.
Boeing in the pre-market negative here by 0.7%. That's the latest for Boeing. Here's the latest over in China. Investors betting the government will do more to backstop the economy ahead of the National Party Congress next week. We've had a big rebound in stocks in China, helping to push equities in Asia to their best February since 2015. The CSI 300 up by more than 9%. Virginie Masseneuve at Allianz Global Investors saying the country is headed for the Great Reset. Virginie joins us now for more. Virginie, wonderful to hear from you because you've been constructive on this part of the world, and I struggle to find anyone else that has been. Can you tell us why, apart from the fact that this is really under-owned?
Yes, thank you. Listen, you have the headlines and you have the changes that are taking place in China, where President Xi Jinping is really building a common prosperity economy. And that's a new concept, really, given the demographic profile, given, the development that China has achieved. This is something that is well understood. What has happened, however, given the volatility, is many foreigners have left the market, and actually over 90% of the domestic Asia market is now held by domestic investors. So I think in that context, any good news, any labeling, if you want, of the bad news is a source of a potential rally. We like innovation. We don't buy China as an ETF. We buy China as an active, if you want, a battle fertile ground where you find a lot of very interesting companies in green tech, in med tech, in tech, as you know, bifurcation of the world's standards given the New World Order and what I call China Phase 3 means that a lot has to be rebuilt in China, and semiconductors, etc. There's a lot of super innovative and very interesting companies.
Virginie, how do you sort of shape your view on China with things like China's banning of certain types of trading, with their banning of certain quantitative traders who maybe do the wrong trade?
Yeah. So listen, it is an emerging market economy, and we know that some emerging markets have that uncertainty linked to it. However, it is a very large market, and as I said, you really don't want to have a top-down ETF kind of view. You really want to work with from the bottom up with quality management team, understand the business models, and really have that long-term appreciation of the potential of a company, but of course, very, very focused on valuation and quality of management.
Is this a trade, Virginie, or is this something longer term, especially given the inconsistent policies from the top?
So I think they're consistent within the Chinese perspective, if you want, in terms of, again, thinking about that long-term common prosperity approach. Listen, in terms of a trade versus long-term, I'm in the long-term camp because I think it's the second largest economy in the world. If you look at the wealth creation, if you look at the potential for innovation, if you look at the transformation of the economy, if you look at the global South and China's influence. But I understand that for some people, it might be a trade if you have none in your portfolio today, given how well a lot of markets have done around the world in the past 18 months. Maybe that's something people will want to look at on a trading basis.
As you talk about long-term investment in China, the White House, President Biden just puts out a statement. He says, I'm announcing today unprecedented actions to ensure that cars on U.S. roads from countries of concern like China do not undermine our national security. He's directing the Commerce Secretary to look into this. How do you deal with long-term view on China when you have this acrimony that continues between Beijing and Washington?
Yeah, that's definitely part of the risk, right? Very, very clearly. And geopolitics will play my views on New World Order and geopolitics will continue to play a growing role in markets as the world is becoming multipolar. And the Trump administration will clearly continue to create some pressure. From a bottom-up perspective, when you look at those companies, you have to attack very conservative assumptions with regards to development in markets such as the US and even potentially Europe. And only if given very conservative assumptions, you still think there's a lot of upside potential given earnings profile on a 3 to 5 year basis, then you would get into those stocks. So again, it's a stock by stock decision and framing within a long-term time horizon, but with awareness of short-term risk.
You mentioned what would happen if we saw another Trump administration, but do you actually think trade policies or any policies, really, export controls, penalties, would change whether or not it's Trump or Biden?
I think they will probably come up in different format. If you look at the current negotiation that just took place, we had, to a certain extent, a lot of biting. But in the end, a common understanding that the relationship for the U.S. and China is important to the world. It is important to China and to the U.S. So I think you have to discern the noise of that, political talk with what is going on in the background. And we know that in the past 18 months, there's been a lot of touch points between the two administrations, if you want. I think that this will prevail independent on who is in power in the White House, but the noise will probably be louder. So you want to be very conservative with your valuation assessment and understand that geopolitics will continue to have a growing role on markets.
Virginie, thank you. Virginie Masseneuve of Allianz Global Investors. Thank you very much. Statement from the President on addressing national security risks to the US auto industry. Let's get to that statement right now. I'll quote some of it for you. China imposes restrictions on American autos and other foreign autos operating in China. Why should connected vehicles from China be allowed to operate in our country without safeguards? Lisa, today I'm announcing unprecedented actions to ensure that cars on US roads from countries of concern like China do not undermine our national security. I've directed my Secretary of Commerce to conduct an investigation into connected vehicles with technology from countries of concern and to take action to respond to the risks. As President, I vow to do right by auto workers and middle-class families that depend on the auto industry for jobs. With this and other actions, we're going to make sure the future of the auto industry will be made here in America with American workers. Now, you can decide whether you want to put these two events together. We've just received this statement. We also understand in the last 20 minutes or so, we will not be hearing from the US Trade Representative Catherine Tai this hour. And we would have liked, of course, for her to respond to this statement from the President this morning.
How much heavy lifting is national security doing, and how much is it a fear of really blowing under the water some of the U.S. auto manufacturers? Look, a lot of people have been expecting this. How are you going to create a moat around the U.S. auto manufacturers at a time where the Chinese manufacturers are doing it cheaper and faster? Here's the question. What are some of these provisions? Is this tariffs? Is this just an outright ban? How far does this really expose to the potential for challenges? That's some of the questions.
Made in China EVs, as you know, are already subject to a 25% tariff. Got to throw in the 2.5% tariff on imported autos as well. You just wonder where this is going, how much higher it will be, and if this is about getting in front of what we could see from former President Donald Trump on this campaign trail.
Well, and then how much is there a daylight? I mean, you've been talking about that a lot, Annmarie, but to me, between the two candidates, to me, there's just a real question, and you've brought this up, John. What does this mean in terms of U.S. auto manufacturers and whether basically certain of them are allowed by the U.S. government, whether they are prohibited from buying certain goods from overseas countries, because that could potentially harm national security? It raises a lot of questions here. I'd be really curious to hear some more details.
We'll pick up on that story in just a moment. Let's get you an update on stories elsewhere this morning. Here's your Bloomberg Brief with Danny Berger. Hey, Danny.
Hey, John. Another government shutdown may be averted. Congress's leaders struck a last-minute deal to provide one more week of funding after Saturday's deadline. It will keep parts of the government funded through the end of September, but other agencies like Defense and Homeland Security departments could still face a March 23rd shutdown deadline. Speaker Mike Johnson plans to bring the measure to the House floor today. Shares of Snowflake are plunging pre-market. If this loss holds 23%, it would be the biggest decline on record. The software maker delivered disappointing sales forecasts. It also announced that the CEO, Frank Slootman, is stepping down, and he will be replaced by the company's senior vice president of AI, who, it should be said, once worked for Google Advertising. AMC Theaters is cutting the pay of its CEO by 25%. After a bad 2023, fourth quarter profit fell short of estimates despite a sales boost from Taylor Swift and Beyonce's concert films. AMC stock has fallen significantly over the last year, but now it expects revenue to drop as much as 9% this year because of a limited film release slate. And that's your Bloomberg Brief. John.
Danny, thank you. Appreciate it. Up next on the program, trade tensions between the world's largest economies.
America's fundamental economic strength means that we have nothing to fear from healthy economic competition with China or any other country.
That conversation up next, live from New York. This is Bloomberg. Live from New York City, equities here down by 0.25% on the S&P 500. Yields higher by 4 basis points. The 10-year 430.73. Under surveillance this morning, trade tensions between the world's two largest economies.
As I've said before, America's fundamental economic strength means that we have nothing to fear from healthy economic competition with China or any other country. I and other U.S. officials have repeatedly stated that the United States does not seek to decouple from China.
Here's the latest today. The Biden administration is weighing the fate of Trump-era tariffs amid ongoing tensions between the U.S. and China. The decision coming as competition ramps up for raw materials, electric vehicles and chips to power artificial intelligence. Bloomberg's Vonnie Quinn is at the WTO conference in Abu Dhabi, and she joins us now for more. Vonnie, can you just frame for us that tension that's playing out where you are right now?
Well, let's just put it in the words of Paraguay, which put out a statement, John, saying literally that rich countries that have long wanted poorer ones to reduce subsidies and lower trade barriers are now being called on their own governments to reduce trade barriers. And they don't specifically cite things like in Europe, the carbon border adjustment mechanism, or in America, the subsidies for semiconductor manufacturing and for electric vehicle battery manufacturing. But that's exactly what Paraguay and those that support this statement are saying. They're essentially calling out the hypocrites, as they would see it, for subsidizing their own domestic industries and telling the less developed countries to not subsidize theirs. And in a case like India, for example, which is being seen as a real holdout here, India is trying to protect its 9 million fishermen and anglers that are trying to subsist on very low wages. And other countries are also trying to do the same for their populations, but also remember electorates. There are a lot of elections happening this year.
Vani, do you feel like people are getting split into camps where their countries are being forced to choose between China and the U.S. and to kind of sit with those people at the table and ignore the others?
To a certain extent, Lisa, there's a great word that is only used at the WTO. It's almost a new word, plurilateral. So it's the idea that you can have a multilateral agreement, but really only among the countries that agree with each other. And you don't hear this word used anywhere else except at the WTO. And in fact, I spoke with the Irish Trade Minister earlier on, who had a good insight into how conversations are going. He said there's a lot of pessimism around. And for example, on the e-commerce tariff moratorium extension, which is being held up by potentially India, Indonesia, and maybe South Africa, he said that what will end up happening if these countries don't agree to extending the moratorium is that you'll get a plurilateral agreement with all the other countries that do, and that these 3 or 4 countries will be left out. He said that would be a shame and it would be a very difficult decision to make, and he hopes it doesn't happen. But that's essentially what he was hinting would happen. And there you have it, a split right down the middle with some holdouts, and they're not getting the concessions that perhaps they would like, and the other countries just banding together and deciding they're not giving those concessions.
Speaking of electric vehicles and subsidies, we just heard from the president. He's talking about the national security risk to the U.S. auto industry. We've obviously seen subsidies from China when it comes to EVs. You talked about this race for the subsidy race. Brazil talked a lot about this, saying it's the elephant in the room. Well, those kind of countries, what are they going to do to remedy that? Is there going to be, trade remedies to try to combat some of these subsidies?
I think the answer there is that they are going to continue subsidizing their people, at least as long as they get re-elected again, or as long as they need something else. And don't forget, they're also, in conjunction with the WTO meetings that are happening, they're also conducting negotiations on free trade agreements. So India, for example, right now is in active discussions with the UK, with Australia, with the European Union on free trade agreements. Now, none of them have actually come to a conclusion. There have been several rounds of negotiations with each individual bloc or each individual country. There seems to be stumbling blocks. I spoke also with the India Commerce Minister earlier, who arrived late because he was actually campaigning with Narendra Modi in India for likely elections in April. He maintained that all of these things are separate, that they shouldn't be combined, but of course we know that they're combined. You can't negotiate a free trade agreement without coming to terms with some of the problems that WTO members are trying to come to terms with right now. And the Director General earlier on today was very optimistic and said she hoped that there would be an agreement and that there would be what they call a chair's text at the closing ceremony this evening at 8 o'clock. Since then, and just in the last hour, we've been told that that closing ceremony has now been postponed till at least midnight tonight.
They've got a long list of things to work through. Vonnie, appreciate the hard work over there. Thanks for joining us. Vonnie Quinn there of Bloomberg in Abu Dhabi. Chinese EVs pose national security risks. That's where we are, Bramo. This is where it's going. We've been talking about this for a while. This is where it's going.
The fact that they're saying it's a national security risk because they're in your cars, they can see you, and what are they going to do with the data? And then they say we're going to protect American jobs. So which is it, right? Is this truly a national security concern, as we've seen with the chips, or is this something more in terms of protectionism?
Well, it sounds a lot like protectionism. And what you hear, though, from Congress, and we heard yesterday from Senator Hawley, he was talking about what's going on in Mexico. China is going in on Mexico big time when it comes to EVs. And his concern is this is a backdoor for American consumers to get access to some of these Chinese electric vehicles. So, one, going around some of these national security concerns, but also these cars are being made in Mexico and they are priced point-wise, much cheaper than the EVs the United States is offering.
We'll continue this conversation in the next hour of Bloomberg Surveillance. Wei Lee of BlackRock, Matt McGuinness of the Committee for a Responsible Budget. I laugh because, good luck finding one. Winnie Caesar of Credit Sites and Dime Brand CEO John Payton. All of that in the second hour of Bloomberg Surveillance. Up next, live from New York City on PCE Inflation Day. Equity futures negative by 0.2% from New York. This is Bloomberg.
Inflation is not really in a last mile mode on its way to 2%.
The inflation data is going to get much more bumpy.
If anything, I think you're going to see this back and forth.
The data can switch quite rapidly, which in turn can have a rapid effect on financial conditions.
The Fed is beginning to open the door for a change in policy.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
The second hour of Bloomberg Surveillance begins right now, live from New York City this morning. Good morning, good morning. For our audience worldwide, this is Bloomberg Surveillance alongside Lisa Abramowicz together with Annmarie Hordern. I'm Jonathan Ferro. Your equity market on the S&P pulling back by 0.2%. We can talk about PCE. We'll do that in a moment. The inflation data about 90 minutes away. We could talk about Washington, D.C., avoiding a government shutdown. For now, that's good news. But we should probably talk about this. Protectionism and electric vehicles. The very fact that the President of the United States believes that Chinese EVs could pose a national security risk.
If that's the case, you consistently push that through. What then is the logic behind TikTok? What then is the logic behind a whole host of other things? We've already seen this with certain chips. Now we're seeing it with this new statement out with respect to electric vehicles. The next paragraph, though, of course, is talking about protecting U.S. jobs.
We've been waiting for this for quite a while. Let's be clear, we're still waiting for the policy. So this is where the policy is currently. It's 25% tariffs on Chinese EVs. Throw in another 2.5% on top of that for the tariff, the tax duty on top of an imported vehicle into the United States of America. How much higher is that number going to go?
Well, exactly. And who's going to buy a car when there's a 25% plus tariff on them? So potentially we could see the number go higher if they want to extract more tariffs when it comes to Chinese goods. What we know now just from the president is that they are announcing actions to ensure that cars from countries like China don't underscore national security interests. So they're directing the Commerce Department to conduct an investigation. What do we get at the end of the investigation is the big question. But to Lisa's point about national security, we've seen this administration really ramp up their concern about national security in China. Remember the cranes at the ports? That's now a big issue of this administration. If they're not going to allow Chinese cranes at ports or don't want to welcome them, why would they allow Americans to get in the car? But then the big issue, of course, is American jobs.
What is this industry going to look like in 5 to 10 years? We talked to Pierre Ferro of New Street Research about this earlier this week. Whether this whole industry would descend into just a series of state-sponsored national champions protected by massive tariffs to prevent competition from coming in. And I'd ask this question this morning as well. Is the EV market struggling because of Chinese competition? Or is the EV market in this country struggling for other reasons?
It's a great point, especially because a lot of people will say that actually if the cars were cheaper, you'd have greater EV adoption. So a lot of people who are for this transition say you allow everybody in, you get to where you're going to go much quicker, but you don't protect necessarily U.S. nationals, which is, I guess, one of the main issues.
But China has the biggest hold because they have the ingredients it needs to make an EV. They have the access to the raw materials and 85% of the processing to make that battery. When I talk to people in the commodities world, they say China's long game isn't just selling the battery to the United States. It's saying you cannot have this battery unless you buy the car that's attached to it.
What's the retaliation look like, would be the question I'm going to ask as well. What would that mean for Tesla? I was just thinking about what emojis Elon Musk might use this morning on the prospect of having Chinese EV manufacturers basically prevented from operating here in America. Maybe a salute, maybe a cigarette again. After what he said about Apple, perhaps. But if China starts to say, you know what, tit for tat, we don't want you guys operating in our country either, then some of these Western manufacturers have got a big problem too.
There's also this issue of how they develop their own in-house technology. They've already kind of won when it comes to electric vehicle battery manufacturing. When we talk about chip and some of the chip sales from the U.S., from the Netherlands into China, basically, some of these executives are saying, we're not going to sell the chips, but they'll create their own. And that's going to create parallel systems that, you're going to foster through this.
That's the latest from the President of the United States. More on that a little bit later. Let's just turn to the price action briefly and get you set up for that PCE data a little bit later on today. Equity futures right now on the S&P 500 negative. On the S&P, we're down by 0.2%. Yields are higher by 4 basis points, 4.30.14 on a US 10-year. Coming up this hour, Wei Li of BlackRock on why she sees inflation resurging. John Payton of Dime Brands on how his company is dealing with the weakening US consumer. And Winnie Caesar of CreditSights as corporate bond sales hit a February record. We begin with our top story, 90 minutes away from the Fed's preferred inflation gauge, the so-called core PCE deflator. Wei Li of BlackRock writing this. Falling goods prices have been pushing inflation down, but we see that drag fading in due course. We think inflation will resurge due to stubbornly high services inflation, but we expect that to only become visible later this year. Wei Li, I'm pleased to say, joins us now to build on some of that. Wei, let's just talk about it. Just give us some more detail on this, why we have to wait until later this year for this to play out.
While goods deflation is dragging inflation down as we speak, it's running at over -2% rate. So just based on that alone, we actually think that inflation could hit target of 2% later this year. But after goods deflation runs its course, we cannot extrapolate that indefinitely because that's in part due to pandemic mismatch unwinding. Then some of the structural forces like persistent wage pressure could push inflation higher. And geopolitical fragmentation that you talked about earlier on also could push inflation higher. But we believe that ultimately means that inflation will go through a bit of a roller coaster pattern, going down before it then rebounds next year. Now, having said that, the last a few prints of PPI, CPI have surprised on the upside. So even as we go down, I think it's going to be a volatile ride. And today's PC, clearly all eyes on that print.
Wait, how do you stay bullish on U.S. equities despite the fact that you expect inflation to be sticky and bond markets to keep reflecting that?
Well, markets can only focus on one narrative at a single moment. And for now, we believe markets are focusing on the narrative of immaculate disinflation and earnings being very, very strong. So what has happened so far this year is that on the one hand, rates markets are moving closer to where we think things should be, which is around 3 cuts at the beginning of the year. We're looking at 6 cuts priced in by markets, and now that's moving closer to 3 cuts. But on the other hand, earnings are really strong. You look at the first quarter, the latest earnings season reporting for Q4, it's actually almost twice as strong as the expectation at the beginning of the reporting season. So if you think about kind of risk assets valuation being ultimately just discounting future cash flow, discount rates is going up, but cash flow, i.e. earnings, are going up as well, which is why on aggregate markets are up. And we think that this kind of combination can go on for a while before markets then move on to inflation roller coaster. And that actually should become clear later this year rather than right now.
When the shiny object shifts direction, then maybe everyone will look over there. A lot of what you're talking about, the better earnings, the sort of more constructive feel, a lot of people say has been priced in. I get so many emails with the headline FOMO, oh no, FOMO, Momo. And I'm just looking at this and thinking, okay, how do you know it's hit a top? Scott Rubner of Goldman Sachs said yesterday it's impossible to call the top to this euphoric stock market. It's looking tired. However, there is no catalyst for a potential sell-off. Is there a key moment for you that is that shift where you start to adjust?
Well, in terms of the positive sentiment hitting a wall and turning more negative, what we just talked about in terms of inflation roller coaster becoming clear is such a catalyst, and we're paying close attention to wage pressure and participation rate, for example, to monitor that. But in terms of markets priced in for perfection, actually, I would observe that whilst earnings are baked in to be positive, quite positive for this year, when it comes to rates, we're now kind of middle of the range, right? Like markets are pricing in 3 cuts for this year, which is just one more cut versus the kind of the October pessimistic kind of pricing. So because we actually think that inflation could surprise on the downside in the coming months and quarters, because goods deflation is very, very powerful, we can see rate pricing swinging wildly again. So as markets then kind of wake up to, well, maybe 3 cuts, maybe even more, and maybe even less, I think that actually could then create further volatility slash momentum on the upside, even though ultimately we think 3 is where we're going to settle. But inflation falling to target is currently underappreciated by markets. If you look at 2-year break even, it's at almost 2.8%, which is the last time it was at these levels was in March 2023, when inflation was comfortably above 5% back then. So I think markets are really fixated on the last mile of inflation being difficult to achieve, when we actually think because of the powerful goods deflation, we could get there. But then the focus is going to get to the inflation roller coaster.
This sounds like a mess for later this year, Wei. I want to talk about the rest of the world. Never mind the United States and the prospect of that inflation roller coaster. So far, month to date, so this month, the Nikkei 225 is up by 8%. The CSI 300 in China is up by something like 9%. Wei, these are big monthly gains abroad. I think we had all-time highs in the last week as well in France and Germany. What do you make of what's happening abroad? How sustainable do you think this is, Wei?
Well, our biggest conviction currently in international markets is Japanese equity market. We upgraded it twice last year. We continue to stay quite overweight in this market. The first wave of Japanese equity performance was very much driven by markets getting excited about the exit from decades-long of deflationary mindset. But from here on, we think that it's going to be catalyzed and driven by micro development. Earnings are coming through really, really strong. And we also think that, yes, this year is going to be the year where Bank of Japan start hiking rate, but they're going to be really careful as they do that, because they don't want to accidentally make the policy mistake of killing this exit from deflationary mindset, which is why we think that market pricing for them lifting rates is a little too aggressive. We think that they will lift rates, but they're not going to move too far from zero, which is still a very supportive kind of monetary policy environment. You talked about China. Valuation is very, very cheap. There are catalysts in terms of policy support coming through, but fundamentals are very, very challenged still. We're talking about real estate overhang. We're talking about aging population, which is why when we balance all of these factors together, yes, we see that there could be some bounce from this very low bottom of valuations, but we're still neutral. We're not overweight to chase this rally, and we think that there are better opportunities elsewhere.
What's your pushback? Because we just heard from Virginie that she likes China. We heard from Evercore ISI's Julian Emmanuel that he also is bullish on China just because it can't go much lower. What would make you more bullish on a country that is the world's second biggest economy and has been all but left for dead by a lot of international stock traders?
Well, to be fair, we are neutral, so we're not underweight. We very much recognize that valuation is compelling, and there are near-term policy support that may well be behind some of the more bullish calls. But from a whole portfolio perspective, we're talking about risk-adjusted returns. And when we try to measure, even just looking backwards, kind of what the market were able to deliver the last 2 months or so on a risk-adjusted basis, is still less attractive than what we can get from Japan, for example. So we're neutral, is not too bearish, is not too bullish. From a whole portfolio perspective, we think that there are better opportunities elsewhere where we are, for example, overweight Japan, we're overweight US equity market with a focus on tech and AI, which we think that delivers continued runway.
This is going to sound so specific, but I just want to know what happens to the Nikkei if the dollar-yen drops from 150, Bramo, to 120.
I mean, it's a good question.
What happens, Wei, if we drop to 120 specifically? Now, I'm joking, but seriously, what happens if this Japanese yen picks up? Real strong rally off the back of the BOJ starting to hike.
Well, that's a very, very important point that allows me to clarify. We like Japanese equities on a currency unhedged basis, just to buffer in the fact that, well, 150 off the back of policy divergence, there is room for that to come back, right? And given the fact that Japanese equities tend to be negatively correlated with the currency, there is a auto correlation that we want to bake in this unhedged currency, Japanese equity call. Now, having said that, we do think, for example, like Bank of Japan, the next meeting is not really a live one because they're going to be so very, very careful not to make the mistake to cue this early exit, this early signs of exit from the inflationary mindset, which is why we think that, yes, markets think that it's going to really start hiking and create significant kind of policy divergence versus the rest of developed central banks because they are cutting and Bank of Japan is hiking. The divergence may not be as high, as big as markets seem to be expecting because Bank of Japan will be very careful because this is, we're talking about, decades long deflationary mindset. They want to be so protective of this exit.
This has been a long, long journey. Wait, thank you. It's good to hear from you. Wait, Lee there, BlackRock. Dollar yen right now, break at 150, 149.96. Let's give you an update on stories elsewhere this morning. Here's your Bloomberg Brief with Danny Berger. Hey, Danny.
Hey, John. Republicans in the Senate have to decide just how loyal they want their next leader to be to Donald Trump. Mitch McConnell is stepping away from the leadership position after the November election. His successors are known, the most likely successors, that is, as the three Johns. John Thune of South Dakota, John Cornyn of Texas, and John Barrasso of Wyoming. Now, unlike McConnell, all three have endorsed the former president, though Thune held out until this week to do so. The SEC is investigating whether OpenAI investors were misled while the company was shaking up its leadership last fall. The Wall Street Journal reported that regulators are looking at internal comms by the CEO, Sam Altman, ones related to his ouster in November. Sources familiar with the probe say that the SEC subpoenaed OpenAI in December and told senior staff to preserve internal documents. OpenAI's board chair says the company will continue to strengthen governance. AMC Theaters is cutting the pay of its CEO by 25% after a bad 2023. Fourth quarter profit missed estimates despite the sales boost from both Taylor Swift and Beyonce concert films. AMC now sees a 9% revenue drop this year because the slate of films to be released is so limited. And that's your Bloomberg Brief. John.
Danny, thank you. Up next on this program, guess what Washington is doing? Kicking the can down the road.
The American people deserve better than this. You wouldn't run a peanut stand over how Congress is trying to do the national budget.
I think a lot of people might agree with that sentiment. Live from New York City, this is Bloomberg. Inflation data 1 hour, 11 minutes away. Equity futures on the S&P 500 negative by, let's call it 0.25%. Yields inching just a little bit higher right across the curve at 4 basis points on a 10-year. 430.73. Under surveillance this morning, kicking the can down the road.
The American people deserve better than this. You wouldn't run a peanut stand over how Congress is trying to do the national budget. The fact that we do everything to avoid a shutdown. Well, the government's going to experience a national shutdown if we keep going with the debt that's accumulating in America. We'll look at the text. Again, it's one crisis to the next. It doesn't have to be this way.
Here's the latest. Congressional leaders reaching a deal to avoid an imminent government shutdown, agreeing to another stopgap spending bill. The House set to vote on the deal today, which would provide 1 week of reprieve, pushing the deadline to fund some government agencies to March 8th. A second deadline would be 2 weeks later, on March 22nd. Maya McGuinness of the Committee for a Responsible Federal Budget joins us now for more. Maya, I'll ask you a question that I think would be the opening of your TED Talk, so you could go a long, long time with this one, but just how unsustainable is this path that we're on right now in Washington?
Well, we have now kicked the can so many times on the fiscal situation that there is no way that we will be able to fix the huge debt threat that we are facing without really major shifts. And as we can see, when the government's talking about even very small changes, which is what's going on in this deal, they are basically unable to make very difficult choices and stick with them. So I don't like to exaggerate about this, but I think we're headed towards something very bad on the fiscal front. It doesn't just come from our huge debt, like deficit, interest payments, unsustainable entitlements, all of those things. It also comes from the massive crisis in leadership that we are seeing at this point, where nobody is able to really talk about this issue honestly, make the changes we need to, and we have already waited so long, it is clearly going to be very difficult to fix.
Maya, Trump Looking forward to November election, you're talking about leadership. Trump has thrown around that he's going to pay off the debt. That would be virtually impossible in 4 years. But are you seeing anything, regardless of whether it's Trump or Biden, that would make any implications, improvements in our government deficit?
Yeah, let me just hone in on that Trump point for 1 second. It is so impossible to pay off the debt in 4 years. You would have to massively double revenues, cut all spending, and then some. Those numbers are just pulled out of nowhere and make no sense. And that's the kind of discussion that doesn't help. The other kind of discussion that doesn't help is everybody promising all the things they won't do. Republicans don't want to raise taxes. Democrats don't want to raise taxes on 98% of people. None of the leading candidates with President Trump or Biden are talking about the real need to fix Social Security and Medicare anymore. The Biden campaign and in the Biden's budgets, he has talked about a number of revenue increases. There's no question about it. We need higher revenues in order to close this gap. We need changes in everything, mandatory spending, discretionary spending, and revenues. So there's something he's talked about. The Trump campaign, the Trump administration and in the campaign, they did talk about adding tariffs. That would raise revenue, but it would harm the economy. So net, that might not make any difference. But to your main point, nobody's talking about this as a big issue. Nobody's putting forth the policies that would really make the changes. But when it comes down to this, I will say that the Biden budgets have included some revenue increases that I think there's support for. The risk is, would they turn around and spend them on bigger spending programs, which we've also seen an appetite for.
The heart of the U.S. budget is entitlements, though. Is anyone willing to go there?
Absolutely not. Here is the truth. We have two big programs, Social Security, Medicare. Both of them have trust funds that are going to become insolvent in a decade or so. Instead of talking about all the reasonable measures that we have to put in place, and frankly, we should have put in place years ago, we have the major candidates not promising to touch those programs. And when you have somebody who, reasonably like Nikki Haley or Chris Christie says, we should consider some of these issues, you have to think about raising the retirement age for younger people, not things that affect retirees, but people down the road, they immediately get attacked for it. So we have very little political leadership on what is 100% true, that if we don't make changes, say to Social Security, there will be very devastating automatic benefit cuts to everybody on the program. Those will harm current seniors. So this void of leadership is really leaving people who depend on these programs even more vulnerable.
Yeah.
And it says even more about how broken our political system is, that people aren't willing to level with the voters. And the big competition between the two parties is, I'll give away more than you can give away, which brings us back to this unsustainable debt path that we seem to be stuck on.
Maya, I can feel your frustration and I hear you. And I'm so glad that you join us. And I'm wondering whether people still take your call, whether you call them up and you're like, let's talk. And they're just like, I don't want to hear that I need to take my vegetables again. Basically, do people even take your call anymore?
So behind closed doors, there is a lot of activity. Not only are they taking calls, they're giving calls. And that's both true from members of Congress and folks on Wall Street, because the markets are starting to worry. I'm hearing this much more from financial leaders than I have in the past years when this issue was basically lost in Siberia. But folks in the markets are worried. And yes, there are members of Congress who are focusing on this a lot. There's a big group in the House called the Bipartisan Fiscal Forum, led by Bill Huizenga and Scott Peters. And they have a group of colleagues who all meet monthly to talk about this. There's a lot of effort to try to put in place a fiscal commission that would look at all sorts of things. Of course, you have normal opponents from the special interest groups, the AARP, the No New Tax Pledge crowd. None of them want to make any changes. But there are a lot of members of Congress who are starting to say this is not just weakening our economy, this is weakening our country from a national security perspective. And so they are really starting to work on this. The question is when we can get enough people and the political leaders to really be willing to have an open and honest discussion about it.
I have a feeling we'll be talking about this together for a long, long time before they do anything. Maya, thank you for being with us. Maya McGuinness there of the Committee for a Responsible Federal Budget, of which there isn't one right now. I am so negative about them ever doing anything on this until there is a major problem in the Treasury market. Bramo, and we know why. The moment they talk about doing anything, that gets used as sort of opposition research against the person who's talking about it. It's ridiculous.
Yeah, Nikki Haley, even talking about raising the retirement age. Why do you hate people? Why do you hate the
Trump
retirement?
campaign took our interview with her about raising the retirement age and made ads. It was all over Iowa and New Hampshire. It's the third rail.
Not going to get fixed. Up next, John Payton, CEO of Dine Brands from New York City. This is Bloomberg. getting the secret omelette recipe right now. I'm not sure you meant to share that. Okay, we won't talk about that, but I might start doing it. From New York City this morning, good morning. Equity futures right now on the S&P 500, negative by 1/3%. We're down about 1/4% on the NASDAQ. The data are about 1 hour away. We'll talk about that data in a moment. Into the bond market, 2-year, 10-year, 30-year. Earlier on today, this week rather, closed above 470 on a 2-year for the first time this year. 468.71. Yields a little bit higher here, Lisa, going into that data. We're up 5 basis points.
The whisper data, if there is such a thing for this particular metric, is that it's going to come in a bit hotter. And this just really is on the heels of what we've already seen, which is hotter CPI and hotter PPI. Whether people consider this data to trade off, we shall see. I mean, people will then say, well, it's just one data point, and then we'll hear that next week and then the week after.
Will it push out the Federal Reserve a little bit more? Let's talk about bringing in the Bank of Japan to the rate hike conversation. Dollar yen, bit of yen strength out there. Break of 150 on dollar yen. Briefly, back to 150 right now, negative 0.4%. I said earlier, we haven't seen a close below 150, I think, in about 2 weeks, Lisa. BOJ board member talking up the possibility of rate hikes down the road.
Okay, this is what talking up the possibilities of potential rate cuts, it sounds like. The price target of the Bank of Japan is finally coming into sight. Oh, my goodness, they're going to hike, right? So this is sort of, all right, people have been fed this line before, and so that's the reason why you're not seeing that much action.
Wei Li of BlackRock talked about how long this journey has been, decades.
Yeah.
They're going to move slowly.
Well,
they're going to move slowly. Under surveillance this morning, the data point we've been waiting for all week, the core PCE deflator, the Fed's preferred inflation gauge due out at 8:30 Eastern time. We'll also get jobless claims and personal income and spending data too, plus more Fed speak. We'll hear from Bostic, Goolsbee, Mester and Williams throughout the day. Already heard from President Williams in the last 24 hours. I have to say, based on the dot plot that they put out in December, let's park the news conference with Chairman Powell. Ignore that. Just go to the dot plot. They talked up 3 cuts, implied by the median dot. They're still basically at 3 cuts, and that's what he's speaking to.
Do you think that they feel really good? They're like, you guys are working yourselves into a frenzy in the market. We're staying in one place, and you're coming around to kind of realize that you should have not been freaking out this whole time.
Fortunately for them, they don't have to mark to market every day.
Yeah.
If you did have to mark to market their views every day, I mean, maybe they'd change a little bit, but they don't. And they've been right so far.
Yeah.
So far. Let's see how far this gets pushed out if that inflation data comes in hot again.
Especially considering the fact that there still has enough financial easing that could potentially foster further types of inflation. This is something that people are worried about.
Some latest news on the politics as well, just from Illinois, barring former President Donald Trump from appearing on the Republican primary ballot over his role in the U.S. Capitol insurrection 2 years ago. It's the 3rd state to ban Trump from ballots. Trump planning to appeal the ruling, calling it, quote, unconstitutional. We're going to have a few hearings, aren't we, over the next few weeks?
He's already appealing the one that came out of Colorado, so the Supreme Court is already going to look at this. They'll make the final decision. More importantly, the Supreme Court yesterday says they're going to take up the case involving Trump in terms of immunity regarding the January 6th case happening in Washington, D.C. Now, regardless of what the Supreme Court does, it was a win from the Trump campaign yesterday because this is just a delay tactic. What he does not want is to have this trial happen before the November election. Our polling shows that if he's convicted of a crime, he's going to lose votes.
Let's get to that polling. The new swing states polling coming from Bloomberg Morning Consult. The former president holding a 5-point lead over the incumbent, with perceptions of an improving national economy failing to translate into any insignificant increase in support for Biden. The poll also finding that 80% of swing state voters would describe Biden as, quote, too old. A majority would describe Trump as, quote, dangerous. That's quite a choice, isn't it, going into November?
Too old or too dangerous? I would note that the too old issue happened after the special counsel report that said that this was an elderly man, which is why they didn't want to charge him in the documents case. And then the too dangerous, we've seen an uptick in some of this. This happened after Trump's comments on NATO. And some people think that he's degrading NATO. And then part of that dangerous is also the fact that I just mentioned, if he's convicted of a crime, he's going to lose votes.
That's enough politics. Let's get to the data. Another read on the US consumer coming at 8:30 Eastern time with personal income and spending data just around the corner. Dime Brands will be taking a closer look at the data. The owner of Applebee's and IHOP restaurants reporting 4th quarter profit that beat estimates, thanks in part to an aggressive promotion strategy. The CEO, John Payton, saying this. During the year, we found that guests limited their discretionary spend in response to economic pressures and that this value-conscious behaviour continued in the 4th quarter. While this certainly creates challenging and dynamic market conditions, it also allows us to leverage our expertise in delivering exceptional value. John Payton, I'm pleased to say, is with us around the table. John, good morning.
Good morning.
I want to kick it off with one thing, and I mentioned it in the commercial break, so we should continue this conversation. When Walker Hayes put together that song just a few years ago, Did they talk to you about that ahead of time? How did that work out?
So Walker Hayes wrote the Date Night at Applebee's song 2 summers ago, and it was a gift from above. We did not know it was coming. He is an actual Applebee's fan. He wrote about date night with his wife at Applebee's, and he's been an amazing partner to work with. We jumped on it. Our marketing team was all over it. And so, that led to the commercial, TikToks. He did over 100 appearances for us. He was at our national conference. Fabulous.
Free marketing. How many people are doing date night at Applebee's now? How cost conscious are they?
Well, speaking of date night at Applebee's, we just had our date night event where we had a coupon available for $200 that enabled you to eat at Applebee's every week for 52 weeks with a $30 discount. So it was a $1,500 value for $200. We made that available at midnight a few weeks ago. It sold out in a minute. Some less than a minute. Some commentaries said that we broke the internet. Not quite that. We added server capacity. We added customer support, and our sites might have slowed a little bit, but it was so popular. We did it again at Valentine's Day. 1,000 date night passes.
So what are you seeing with respect to where people are coming from? Is it the same crowd that's always gone to Applebee's that just have more discretionary spending? Or do you see people sort of that might have gone elsewhere, maybe that was more expensive, coming to Applebee's or going to IHOP for an omelet that's very fluffy?
A couple of insights, Lisa, about the consumer. We get asked that question a lot. Are people trading in or out of the category? And from quarter to quarter, we'll see a few more people come in at a higher income level, a few more people at a lower income level. But over time, it's actually fairly consistent. Our core guest from a demographic perspective earns about $50,000 to $75,000 a year. And that is literally looks like America, right? We've got 3,600 restaurants across the country. And so our guests are families with children, older couples who've retired who come to IHOP every day for breakfast. And so what we do see from a consumer behavior standpoint are a couple of things. The first is throughout 2023 and into 2024, our guest at all three of our brands has been remarkably resilient to the extent that it really surprised us a bit. We do see from our data that they're eating out 1 or 2 times fewer, per quarter than they did before. And when they make their choices, they are still looking for full service dining because, prices are up almost 20% in restaurants versus 2019. And so if you're going out to eat and QSRs become more expensive as well, they want that experience, they want the service, they want everything that we have to offer at Applebee's and IHOP and Fuzzy's. Once they find us, they're very value focused. And so, the percentage of our tickets that are taking advantage of our LTOs, our limited time offers, and our value portion of our menus are up a few ticks from where it was before.
So then how do you maintain margins at a time where we keep talking about the fact that people are demanding higher pay? There's a whole question about worker retention. There's a whole question about just the input prices of a lot of foods and how they have remained sticky. How do you manage that?
Yeah, so margins are the biggest challenge in the industry right now, particularly for our owners. We're at 100% franchised, right? So the impact of labor cost, the impact of cost of goods into the restaurants affects our franchisees directly. And so we focus on 2 things. We're doing everything we can to drive the top line, right, through really creative promotions and value offerings. And we work with them on re-engineering as best we can the bottom line. So last year, for example, working with our franchisees, we took out $50 million in cost across the system. And we focus on things that are sustainable and repeatable, so technology, process improvement. One example is we're putting in automated beer dispensers, which saves hundreds of thousands of gallons of beer a year by having more accurate pours and less waste. And so that's the way we're trying to automate things like that and help them manage their costs.
Yesterday, Wendy's had received a ton of blowback when they came out and they're going to do dynamic pricing. They said, no, we're not going to raise prices on busy hours, but maybe we'll offer some discounts online. Could you ever see yourself doing that, sort of mixed pricing depending on peak and off-peak hours?
Yeah, so I come from the hotel industry, right? And I led revenue management when I was at Starwood Hotels for a long time. And as you know, with airlines, with hotels, no 2 people pay the same price for the same hotel room or the same ticket, depending on what channel they purchased it on, when they purchased it, if their loyalty status. We've looked at it for restaurants, but we don't think it applies to us or our customers at this time.
We're hearing the word price gouging a lot down in Washington, D.C. Can you talk to us about what you think about that? How difficult is it to bring prices back down to where they were a few years ago?
It's difficult to bring prices back down when labor costs are escalated and labor is pretty sticky, right? It tends not to come back down. The cost of goods and primarily food into the restaurants has stabilized, and we're even predicting some deflation in the cost of goods into the restaurants for Applebee's in 2024, about flat to maybe +1 for IHOP. When you translate that to pricing, and it's our franchisees who make the pricing decisions because they own the restaurants, typically, pre-2019, everything is pre-2019, right, these days, our franchisees raise prices about 2 to 3% a year. The last couple of years, it's been more in the 5 to 8 or 9%. What we're seeing now with the stabilizing of both labor and cost of goods, we think they're back on a path to that 2 to 3% over the next couple of years.
I want to talk about the automatic beer dispenser, not because I'm actually interested in the automatic beer dispenser, but it sort of highlights the amount. And we talk about, just you get a little bit less, and that's one way to manage.
It's not a little bit less, it's an accurate pour.
Okay, understandably. But then you could just make it an accurate pour of a little bit less. I mean, how much is that something that's going on around the margins? So
never ever. So right now, our definition of value is great food at a really accessible price, an abundant portion, right, and the experience you have in the restaurant. And Applebee's and IHOP and now Fuzzy's, but Applebee's and IHOP in particular have been around for 50 and 65 years, and they've cemented their reputation in consumers' minds as the value-oriented brand in both their categories. And I'm a former chief marketing officer, and what I've been taught about brands is that people go to brands they know and they trust, and you can trust that Applebee's and IHOP are always going to have an abundant portion, and that's sacred for us.
A pint should be a pint. I'm talking English measures, of course, but a pint should be a pint, Bramo.
Well,
no shrinkflation.
I just want to say something.
But warm. The pint is always warm, which I haven't understood.
Well, it's a different kind of pint.
Yes.
We could get into that another time.
I have to say, in Europe, they actually have lines on all the wine glasses to have accurate pours, so it's something that they've been doing
Should
for a
have
while.
an accurate pour.
Okay.
I've saved this to the end of the conversation because I don't want to upset you too much, but this is going to sound terribly rude. So forgive me for the framing of this question. I'm just blunt, British, call me whatever you want. How dependent are you on 40% of this country remaining obese? What happens if Ozempic actually does something about it? What happens to you? What happens to this organisation?
So the response to that is that our menu has something for everyone, right? And if you went to IHOP years ago, it didn't have plant-based proteins. It didn't have a series of egg white omelets. It didn't have gluten-free pancakes. And the same is true. The same is true at Applebee's. So what's important for us is that no matter what the dietary orientation is of someone in that family, that we have something for everybody.
So right now, are you factoring in any kind of shift from that type of change, given the fact that there is a pretty rapid adoption for these weight loss medications?
Yeah, we haven't seen yet any material impact on our business, and we're not factoring it in terms of our predictions about traffic and comp sales, which really our focus is on the menu and ensuring that whether you're at any one of the three brands, there really isn't something for anyone depending on how they eat and how they choose to eat.
But because of this craze almost, do you feel like you're pushed more into being healthier on your menu?
That push preceded Ozempic, right? So the way Americans eat, has been journeying slowly, right, toward more healthy eating over time.
Have the portions changed?
Our portions have always been the same. It's more about what we're offering and having a broader menu.
Can I just ask one more question about the technology investments? I'm just wondering, do you think that we will always have service in the form of a human?
I do. I use the phrase that we are not a technology company that happens to serve food. We're a food company that embraces technology. And so, for example, at IHOP, we've just rolled out a new POS across the whole system. We've got 50 restaurants to go, and with it came handhelds for all of our servers. And so our servers love it because they're turning tables faster, they're making more tips. Our franchisees love it because we're turning tables faster, and we're also raising the average check because servers are attaching beverages more often. Sometimes you forget to put that soda on the tip when you're on the check when you're really busy. So it's technology like that we're using to enable the experience. We're also allowing guests via our app, if they want to order in advance and then seat themselves at the table, they can do that. But it's more about how they want to interact with us and giving them all those options.
John, this was great. I promise never ever to share the secret ingredient in the omelette, okay? ever.
I have no idea what you're talking about.
John, thank you. John Payton, the Dime Brands. John, thank you very much. This was great. Appreciate it. Let's get you an update on stories elsewhere this morning. Here's your Bloomberg Brief with Danny Berger. Hey, Danny.
Hey, John. The U.S. Labor Department caused confusion across Wall Street. They sent an email about rental inflation in January CPI. That message was to so-called super users. It suggested a surge of single-family detached home inflation was caused by adjustments to subcomponents weightings. The pop in owner's equivalent rent was a large factor behind the strength of January CPI. The BLS says it is looking into the data. Shares of Paramount up in the pre-market. It predicted significant earnings growth this year. Investors then overlooked a 6% sales drop, with traditional TV ad revenue falling. Subscriber growth also beat estimates on its streaming service, which Paramount says will be profitable domestically next year. Apple resellers in China are slashing the price of iPhone 15s. It's an unusually long slump in demand. China sales for them dropped 13% in Q4. It's the weakest performance in years, thanks to economic difficulty and Huawei competition. In January, Apple offered a rare price cut on their website. And that's your Bloomberg Brief. John.
That's not looking good. Danny, thank you. Up next on this program, corporate credit in focus.
We've got to watch credit spreads. They are so incredibly tight, not just investment grade, but high yield as well. That's kind of a canary in the coal mine for me.
That conversation up next, live from New York. This is Bloomberg. Live from New York, going into that economic data about 42 minutes away. Equity futures on the S&P negative by 0.33%. We are higher on Treasury yields by 4 basis points, 430.73. Under surveillance this morning, a record month for bond supply.
We've got to watch credit spreads. They are so incredibly tight, not just investment grade, but high yield as well. That's kind of a canary in the coal mine for me. Watching those credit spreads, when are we going to start to see some of those widen out?
Here's the latest. U.S. corporate bond sales setting a February record of $172 billion as falling yields drive investors towards debt and companies take advantage of lower borrowing costs. Willie Caesar of Credit Sites writing, quote, though we're still positive on the long-term outlook for corporate credit, we have been surprised by the relative resilience of credit spreads in both IG and high yield during this most recent move higher in rates. Willie Caesar joins us now for more. Willie, let's get into it. You've got a perfect way of framing it. Just how tight are things on a multi-year, dare I say, multi-decade basis?
Multi-decade for sure. So things are very tight, but there are some caveats to that. We still have pretty wide CCC and distress spreads in the high yield market, though the higher rated parts of the market are trading through the 2021 tights that we had at the height of pandemic-fueled liquidity. And then in the investment grade market, we're trending towards those kind of mid-2000s, 2005 tight, but you still have financials really lagging, and that is what needs to get some giddy up in order to hit those cyclical tights again.
So there is scope for these spreads to get even tighter, is what you're saying?
There is scope. We've been a little bit cautious on that. We feel like this start of the year is almost a repeat of last year, right? We had a slew of kind of Goldilocks data, some surprises to the upside in inflation, yields moving higher, credit spreads tightening on that, and then something happens. There's always something that happens. Now, our big catalyst was the Fed being a little bit more hawkish at the January meeting. That has manifested, and yet credit spreads are still super resilient. And I think that speaks to the technical backdrop where investors have been really underinvested, under-allocating to credit risk, and now they're kind of holding their nose and having to play catch up.
You know, I'm listening to you, and I've been hearing about tight credit spreads. The all-in yield has basically flatlined, around 7.9% for high-yield bonds. Basically, spreads are offsetting some of the fluctuations that we're seeing in benchmark rates. How much would it actually be a negative for spreads widening, bonds selling off, if you get rate cuts, if you get some sort of indication that the economy is weakening? How much is this actually directly correlated to the strength that we've seen in the economy that bleeds through to a better credit backdrop?
Yeah, that's a great point. And the Fed is really threading the needle, right? If you have really dramatic rate cuts because there's a problem, because the Fed is chasing inflation lower or outright deflation, and we go from 5.5% to 2.5% on Fed funds by the end of the year, I think you can safely assume that high yield spreads are going to widen at least some. I don't know the magnitude because there would be cash coming out of the front end, out of money market funds and into the fixed income markets, but you would assume that defaults would rise.
This raises this question of refinancing risk, and we keep kind of asking it in different ways, whether this economy essentially is fine with 5.5% benchmark rate, that these rates are not too high to really restrict growth and, frankly, even inflation. We're seeing all this issuance. Is this a problem, a sort of default risk for companies that are borrowing at these new higher rates?
Well, it's interesting because it is a problem for some companies. We've had this distressed cohort in the high yield market. About 10% of the market on an issuer basis has traded at this distress level, indicating that the market is saying enough is enough. Your capital structures are not sustainable. We're not lending to you. And that number hasn't really moved that much over the past 12 months, even though spreads have tightened up pretty considerably. But then you also have private credit borrowers moving back into the broadly syndicated loan market because there's more demand and you're seeing tighter pricing in the BSL market, which is indicating to me that investors are actually pretty constructive on the lower rated parts of the market.
Is this the zombie washout then? You're going to see like the ones that are not going to work out. That's something that we've been talking about basically for the past 20 years, hopeful?
I don't know that we get a full-fledged zombie washout. I think that there's still too much liquidity.
You've disappointed Lisa now.
I know. I'm so sorry.
You should have been like,
been waiting 4 years for the zombie workout.
It takes a long time for the zombies to get killed, right? It's just the
taken more than a
circling of the
decade.
drain. And yeah, I mean, we have these waves of energy, of retail now, of telecom and media, healthcare to an extent. They're kind of the new zombies, but it's just taking an awful long time because there was so much cash injected into the system. People still need to put those dollars to work. And the new mantra now for LevFin is stay alive till 25 and see where policy rates are.
We've talked about that mantra. I think that's absolutely amazing. You know what's interesting to me is that the zombies are actually thriving now, some of them at least. The cruise lines. We talked about the cruise liners being zombies in the spring of 2020. Look at them now. Look at the equity of them. Last year, some of the top performers on the S&P 500.
Yeah, look at the icon of the seas, just drawing in thousands of people. But this is true. And it's the money. It's the reason that people have so much spending power.
So where do you see difficulties? Can we finish on that? You said that scope for tightening, further scope for tightening would come from the financials. Could they also deliver scope for widening as well, based on some of the struggles we've identified over the last few months?
Yeah, I think that there is that potential. We've been positive on financials. I think that the reality is it's going to take a while for spreads to recover, especially for regional banks. People don't have a good handle on what the new issuance requirements mean for valuations. People don't have a good handle on CRE exposure and what does that mean for asset impairments and write-downs. And so these things just take kind of a long time to actually work through.
Are we seeing much fragmentation, dispersion within financials based on CRE?
Not necessarily based on CRE, but based on big bank versus little bank.
Large versus small?
Yes.
Regional still struggling?
Absolutely. Not necessarily struggling, just not tightening to the level that they had tightened before. They used to trade inside of the GSIBs because of that supply dynamic. The GSIBs were always having to issue a ton of debt. People were like, oh, I own all the JP Morgan that I could possibly own. And so people would be buying, you know, the SunTrusts and the Truists and the
Just say that
banks.
again. Regional banks used to trade inside large banks.
That is correct.
Massive change in the last 12 months.
Massive change.
Yeah.
Just huge.
Just all supply, because they used to be the ones that sold less debt than the big guys. Now the big guys can do no wrong, and that's been playing out in every market.
You'd always see it after earnings season. You'd see the monsters come out and do these massive bond issues.
Yeah, well, we still see that, but people are ready to suck it up because there's nothing else that's really been sold.
Arguably, they want to be there.
Exactly.
Versus the other place. Winnie, this was great. Appreciate it. Winnie Caesar at Credit Size. Amazing to see how tight credit spreads are in the face of record bond supply over the last few months.
Yeah, but this is exactly commensurate with this idea of a hawkish Fed. This is a Fed that sees a stronger than expected economy. And then you've got investment grade buyers. You've got high yield bond buyers that can lock in 7.9% returns over the next, say, 3 to 5 years, whatever the average maturity on this index is. Not so bad, not so shabby. So that's what people are looking at, and the reason why things look pretty intense.
Pretty impressive. Bramo's been waiting 4 years for this zombie workout, you know, things to
It's been longer than
explode.
That. It's been a lot longer.
Well, I'd say, yeah, I mean, I'm being kind.
more
I'm
than a
saying like
decade.
post-pandemic. You've been writing about it for more than a decade.
I've been wrong every time.
It's going to happen. Coming up in the next hour, Emily Rowland of John Hancock, Neil Dutt of Renaissance Macro, and Bloomberg's Ira Jersey and Craig Trudell as well. Fantastic lineup. PCE data, 34 minutes away. Looking around corners, Bramo, warning people about
everything that didn't
downside
happen.
risk. There's nothing wrong with that.
Exactly.
You've got to consider this.
Yes, well, I have actually already got a message. What should I consider now? The shutdown isn't happening.
Exactly.
What's next?
There is always something to consider and worry about.
No doubt about that.
From New York, this is Bloomberg.
inflation is not really in a last mile mode on its way to 2%.
The inflation data is going to get much more bumpy.
If anything, I think you're going to see this back and forth.
The data can switch quite rapidly, which in turn can have a rapid effect on financial conditions.
The Fed is beginning to open the door for a change in policy.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
Inflation data 30 minutes away, live from New York City this morning. Good morning, good morning. For our audience worldwide, the third hour of Bloomberg Surveillance begins right now. We've had upside surprises on CPI, PPI. PCE is just around the corner.
Yeah, and this is really going to be sort of a key driver. If we get 3 for 3 in terms of hotter than expected inflation prints, what does that do to market expectations, not only of Fed rate cuts, or are they going to happen, but also just in general, how sticky this inflation
Everyone
really
seems to be very relaxed around the Fed call now. Governor Waller, what's the rush? Jan Hatzius over at Goldman. Cuts aren't urgently needed. We've priced out the timing of that cut. We've reduced the magnitude of them for this year. What's left?
Well, at this point, do you start thinking about the Jim Bianco view of the world, which is, do rates have to be higher for a substantially longer period of time? Or we're talking about one cut or no cuts. I don't hear anybody else talking about that. I just hear Momo, FOMO, or oh no. I mean, seriously, I can't get over this.
That is your favourite line,
that was really gold, yeah.
Isn't it? Fantastic.
It is.
What was it again?
This is the reason why.
FOMO, oh no,
Momo. FOMO. No. It's is Momo, FOMO, or oh no.
Okay.
And he's basically talking about the momentum rally.
Stuart Kaiser, thank you for that. Super helpful. Let's talk about the data. After this morning, after, let's say, 8:35, all we're going to be talking about is next Friday and the payrolls data. And we've joked, of course, like we joke every single time, that the next payrolls report is the most important one since the last one and before the next one. This is super important. January was a mega blowout, monster upside surprise job report. If you get a repeat of that, then never mind pushing out rate cuts. Maybe Jim Bianco of Bianco Research gets a few more phone calls, because we'll be talking about maybe the possibility that they need to do more.
Or that they need to not cut at all. And how much does that start to affect risk assets in a new way? Because all of a sudden people then have to reset. If this is truly the new normal, then you can't just survive until 25, as we just heard from Winnie Caesar. And you have to think about, this is the new reality, and this is survival.
AMH, let's talk about the jobs numbers. I'll give you a sneak peek of next week. On Friday, median estimate in our survey so far, 180. Previous number was 353. The unemployment rate expected to stick at 3.7%. Citi's estimate just dropped. 145 with downside risk is the call from Citi and Andrew Hollenhorst.
The unemployment rate is going to be key when it comes to this jobs report, because this administration loves to talk about, for the past 2 years, unemployment has been at 4% or below. This is something huge they want to run on. If you have consumers out there thinking inflation is still hard for me, I'm not seeing the prices I were pre-pandemic, I know it's coming down, but it's the rate that's coming down, not the prices I remember. They need that strong job market. And the Conference Board that we got this week in their survey showed that there are some cracks in the labor market, in the sense of how consumers are thinking about it, that they are concerned about their prospects for jobs, which they weren't in the past.
I'm so frustrated with this data, and I know I ranted about this earlier, but it's always so confusing, because people say you see cracks. Sure, you can find the cracks. You can look at, for example, the recent surveys that were done that show more plans to lay off rather than hire. You could see that with just anecdotes. And then the data, strong. It never falters. So what data are we looking at, and how do we understand the fact that the data is not reflecting any of the anecdotes that we hear every single day?
But sometimes, especially we see this in jobless claims, depending on who it was that lost the job and where the job was and what caliber, they may not be able to apply for some of these claims or apply for job insurance. So potentially could be a bifurcation, who is losing what jobs. Look at UPS. They showed up this huge deal for workers, these union workers, but they lost some people in the back end.
Sometimes I just want to applaud Bramo. Just, you know, sometimes I do. I just sit here.
You're like, not right now, though.
This rant was better than the last rant. And that rant came 30 minutes into the programme, so we've still got an hour to go.
Thanks for rating them.
Let's get you set up for the next 60 minutes or so. Equity futures right now negative by 1/3% on the S&P 500. Yields are a little bit higher, up by 4 basis points. 10-year, 430.92. Euro a little weaker, dollar a little stronger on that currency pair, negative by 0.14%, 108.23. Coming up through the hour, John Hancock's Emily Rowland on the road ahead for the Federal Reserve. Ira Jersey of Bloomberg Intelligence pushing ahead to key inflation figures, and responding to them, Neil Dutta of Renmac, breaking down the data and potential market implications. We begin with our top story. Wall Street bracing for the Fed's preferred inflation gauge just under 30 minutes away. John Hancock's Emily Rowland saying this: it is like the Fed gave a last call at the party to end last year. and now it's trying to stop serving. But no one is leaving. It's frustrating that when that happens, right? This everything is awesome sentiment is likely priced into markets. Emily joins us now for more. Emily, why are people leaving?
I'm sure you guys don't remember ever staying too late at the party, right? I'm bringing back, I had to go back in the vault for this analogy, but, it's unbelievable.
Never.
We talked about the pivot party last year and the fact that everybody was invited to it, especially after we saw that 0.1% CPI miss. And then we saw, of course, a more dovish Powell come out in both the November and the December meetings, and we were off to the races. Now, the Fed, of course, has pulled back on that. You talked about some of the speakers we've heard from over the course of this week, but markets just don't seem to care all that much. They're fighting the Fed and winning, and especially the fact that we're seeing the riskiest parts of the market here, the momentum trade, the FOMO trade, it's all sort of the same thing, right? And so risk is really the name of the game today, even though the Fed is pulling back from this messaging. And I think, again, the PCE report is going to be critical in addition to the other inflation data to see if there's a challenge to that narrative and maybe people start to exit the kegs.
Well, let's talk about the price of the story, not the kegs. We'll talk about that another time, maybe. But the price of the story, we were told repeatedly we're priced for perfection. We carried on rallying. Another 5-6% here stateside. We've had an 8 or 9% move in China, an 8% move in Japan. It's gone global.
Yeah, it's unbelievable. And, valuations have not meant much, of course, to this market. We're trading at over 20 times forward earnings on the S&P 500. Incredible rallies. It's amazing to see the poor economic data coming in, especially in Europe. And meanwhile, we've got these markets at record highs. So momentum, sentiment is driving this market higher. And it's pretty hard to fight at this point.
So are you leaving the party?
We're not. We're staying, but we're, sort of maybe sipping on a Coors Light instead of reaching for the tequila right now. So it's really about embracing quality, looking for companies that have great balance sheets. Too many drinking analogies this
morning? Well, I just don't have a Coors Light.
No, quality. That's exactly where I was going to go.
The first thing I was thinking of.
Quality. Companies with great balance sheets, tons of cash, a limited need to tap the capital markets in order to grow. Now, of course, the poster child for quality is mega cap tech. We still like technology. We're not downgrading it because it ranks really high on our quality metrics, but we need to think about diversifying away from that, given the fact that tech's trading at about a 40% premium to its long-term average. So we're looking at areas like U.S. mid-cap equities, which are trading at a 1 standard deviation cheap to their long-term average, and they're actually trading at the cheapest level to large cap since 1999. So that's an area that we want to look at. We've talked before about the benefits of onshoring and how that's impacting that space, especially mid-cap industrials right now, an area that's benefiting from fiscal spending that, by the way, we're still doing. And one reason that the soft landing narrative continues to play out here is because we're pumping about $2 trillion into the economy at a time where it's growing 3%. This is pretty wild.
So let's talk about the anatomy of this party, right? We had Jay Powell come out and say, basically endorse the idea of cutting rates, even if we don't see pain in the economy. People have gone to the races with that. Yeah. What is to say that this party will be stopped, even if they cut rates fewer times than expected? What would it take? How high is the threshold at a time where the fundamentals people keep saying to us look pretty good?
Right. Well, there's a kind of dark side to this improvement that we've seen in economic growth and this modest reacceleration in inflation, which is that the longer rates stay elevated, of course, the more likely it is that we have some type of financial accident or that something breaks, or even just that it starts to put more stress on the economy. So the good news for the economy, of course, is translating into this potential bad news on the rates front. Maybe it takes a while to get there. We're still kind of living in this never-ending late cycle environment, but ultimately higher rates should tip us into contraction. It's really hard to see any signs of that right now.
Given that, and this is something that we were talking about at the outset as we wait for this 21 minutes out from the PCE report, how much are we looking at a Jim Bianco scenario of no rate cuts this year or one rate cut at a time where these rates are not necessarily showing their restrictiveness yet?
Yeah, I think it's becoming increasingly likely that maybe we have no rate cuts this year. Our base case is that 3 cuts make sense, given the fact that rates are probably too restrictive, given the level of inflation. But if the party keeps going and economic growth continues to reaccelerate here globally, maybe none.
What evidence is there that higher rates are hurting this economy? Can you point to something right now? Like, what's happening?
Well, it's all anecdotal. You think about, I had a chat with my stepdaughter who's in her early 20s about credit cards.
Right.
You know, and I'm talking to her and I'm saying, hey, you know, credit card rates are 30%. You know, you want to be careful. By the way, you can earn income as a bondholder, right? She was like, what? But, you know, it's really about thinking about anecdotally how it's impacting the consumer. Or you wake up in the morning and there's more layoff announcements, but it's not translating into the hard data yet. So it's there, it's simmering. By the way, take a look at initial claims. They were heavily revised in 2008 after the fact. So I think there is a little bit of wonkiness, to use a Lisa word, to the data here. As we kind of think about it, we got to take it with a grain of salt.
You mentioned credit cards. What about delinquencies? We are seeing them rise.
Yeah, and we're seeing a lot of use of buy now, pay later. And so consumers are pretty confident about their job prospects, especially today. So they're using leverage in order to continue spending. You know, I don't think it's a dire situation for the consumer. As long as everybody still has a job and feels fairly confident about the labor market, they're going to continue to spend. But the leverage is there. And I think it's a concern as we head into the back half of this year.
How difficult is it to get a 22-year-old to buy bonds? How tough is that?
That generation is actually pretty conservative, believe it or not.
Are they really?
Totally. Yeah.
I thought it was all sort of meme stocks, Bitcoin. Let's go, let's go,
That's
let's go.
my 14-year-old.
Yes,
so
my 14-year-old
that's the even
too.
younger
He's
age
totally
group.
into that.
Same.
He wants
Okay.
to buy an NFT and he wanted to lever it up.
So their risk appetite is sky high.
Yeah.
Where does that conservatism come from?
What happens when they're 19 and don't leave the party?
Well, they do this thing called loud.
What happens?
They do this thing called loud budgeting. They go on TikTok and explain to their friends what their budget is going to be, and their friends hold them accountable.
Right. That's
never
actually
heard of
happening.
that.
Not in my household.
I hadn't heard of that either. Thanks for that. Emily, you're sticking with us, I hope. Emily's sticking with us. Let's get you an update on stories elsewhere this morning. Here's your Bloomberg Brief with Danny Berger. Hey, Danny.
Hey, John. The SEC is investigating whether OpenAI misled investors when it shook up leadership last fall. The Wall Street Journal was reporting that regulators are looking at internal comms by CEO Sam Altman relating to his ouster in November. Sources say the SEC subpoenaed OpenAI in December, asking senior staff to preserve internal documents. OpenAI's board chair says the company will continue to strengthen governance. Weight Watchers shares falling after Oprah Winfrey said she would leave the company's board. If that fall sticks of 25%, the stock would be trading at a record low. Weight Watchers is trying to stay relevant in the Ozempic era. Winfrey says that she'll still work with the company in, quote, elevating the conversation around obesity. She's served on the board since she struck a deal with Weight Watchers in 2025. Republicans in the Senate have to decide just how loyal they want their next leader to be to Donald Trump. Mitch McConnell is stepping away from the leadership position after November's election. His most likely successors are known as the three Johns: John Thune of South Dakota, John Cornyn of Texas, and John Barrasso of Wyoming. Unlike McConnell, all three have endorsed former President Trump, though Thune held out to do that until this week. And that's your Bloomberg Brief. John.
Danny, thank you. Let's just pull up WW again.
Yes.
Down 25%. It's unreal, isn't it?
Okay, this is the other part of the story. Yes, she's stepping down from the board, but it was reported in December that she is taking a weight loss drug as a maintenance tool and basically said, I'm absolutely done with the shaming. So it raises this sort of existential question of meal planning and these other types of tools if the poster child is also using the weight loss drugs.
What's a maintenance tool?
To maintain your weight lower. I don't know. I'm not sure.
I think it's either exercise or Ozempic, depending on how you maintain.
Sort of microdosing Ozempic, is that it?
You know, Oprah Winfrey, we welcome you to come on the show and to join us to talk about it and the trends that you see coming forward.
About losing weight?
And about the use of medication as a maintenance tool.
Okay, up next on this program, not that. Counting down to the data point of the week. I mean, we could do
You're
that.
disgusted with me. It's fantastic.
Really, what's happened in the bond market is it looks like the market got ahead of itself. It said, okay, this is over. Let's throw in the towel. Rates are going to go lower. Time to buy yields.
You just walk 30 minutes a day on incline on a treadmill.
there's that too.
It's secret weapon.
Yeah. Is that,
Summer
are you
shred.
recommending? Well, I can't.
Incline, 30-minute walk.
Leg day. Don't
yeah,
do it.
you know, don't do that.
Okay.
A lot of controversial points on this programme in the last 20 minutes. Perhaps the most controversial, Coors Light quality beer. I mean, like, I'm just saying it. That's not, I'm not saying it's not. Just
the question mark.
Respond.
Yeah,
discuss.
Discuss.
There you go.
Yeah.
Equities right now. Negative 1/3% on the S&P 500. Yields up by 4 or 5 basis points. 431.32. Under surveillance this morning. Counting down to the data point of the week.
Really what's happened in the bond market is it looks like the market got ahead of itself. It said, okay, this is over. Let's throw in the towel. Rates are going to go lower. Time to buy yields. And what's really happened is we're not there yet. And thus we've seen a very strong movement in yields upward again, which is very consistent with this idea that the market went too far and got too excited.
Here's the latest. The Fed's preferred inflation gauge, the PCE deflator, just moments away. The stage is set for the data to jump following January's hotter-than-expected CPI and PPI reports. Bloomberg's Ira Jersey joined us now. Ira, what are you expecting, you and the team, in 12 minutes' time?
Yeah, so we're expecting the 0.3 pretty much in line with consensus, but we will be looking at a lot of the details. Where is the inflation being generated from, and then of course some of the core measures, which the Federal Reserve will certainly be keen in on very, very closely. So we get a 0.4, and we're probably off to the races, looking at 4.5% on 10-year yields pretty quickly, John.
Ira, we've priced out rate cuts pretty quickly as well. We've priced out 3 or 4 of them so far this year. How much space is there to carry on doing that?
Yeah, I think it's possible, and more importantly, when even away from whether or not the Fed's going to cut rates at all, the options market. So when you look at options on short-term interest rate contracts, are actually pricing for some chance of a hike this year, and that's a massive sea change. Remember, it wasn't long ago we were pricing for 6 interest rate cuts with 0 chance of any hike, and actually almost a 0 chance of only 1 hike, or 1 cut rather. And now the fact that we're starting to think that, hey, maybe the economy is going to be strong enough and inflation high enough that the Fed might have to not only pivot to no cuts, but actually be thinking about hiking is a really big sea change. Now, right now, it's mostly just like tail risk hedging, but at the same time, that has had significant effects on the front end of the market. So you look at where 2-year yields are. 2-year yields to get back to 5% would not take very much. Pricing out 1 more cut would lead us back to about 5% on 2-year yields, according to our fair value models.
Ira, I want to just sit on what you just said. 4.5% is very seeable in your view in a heartbeat if we do get a hotter than expected core PCE print. Can you just talk about what that means with respect to positioning and whether you see the sell-off potential as greater in the long end at this point than even the short end, which already has done a lot of the work?
Yeah, so that's a interesting question, Lisa, because a lot of the positioning data that we see is much cleaner now than it was. So the market had been pretty bulled up not so long ago. That's shifted a lot. You look at some of the survey data of portfolio managers who manage duration risk, and now they're actually a little bit short. So while we think that this very tight range, look, in the last 3 weeks or so, we've only been in a 14 basis point range in the 10-year. We haven't seen that for the better part of about since 2021. So with that type of very tight range, it means that there's going to be a lot of people with stops and people who are long who are going to stop themselves out probably when we get above 435. And then that's what's going to, potentially move us back to 4.5. At that point, I suspect that you'll have some short covering. You'll have some people saying, well, 4.5 is an interesting place to get into the market. So that's an important stopping point. It's also on the technical chart. So Chris Kane, one of our chartered market technicians here at Bloomberg Intelligence, helped me with in a note that came out just this morning, looking at that 451 actually is a very interesting target, at least near term. Above that, you're talking about getting back to 5% probably on 10-year yields.
That's very, very specific. Ira, thanks for that. Ira Jersey, I know you've got to run. Appreciate your time. Ira Jersey there on the bond market. Talking up 2 levels here. One on the 10-year maturity that Lisa was talking up, 450. 431 is where we are right now. On a 2-year, the prospect of getting maybe back to 5%. The table's full going into this data. Emily Ronan back with us. Mike McKee around the table as well. Emily, let's talk about that. The prospect of going back to 450 on a 10-year, 5% on a 2-year. Do you think the equity market can keep looking past that?
I think that would create a challenge for stocks. There's been such a tight correlation until very recently, of course, with rates and equity markets. And I think you're going to start to see that challenge. I mean, talk about 5%. I don't think stocks would like that very much. I think there are certain parts of the market that would do fine. Again, higher quality, I think, is an area that can survive that. But really want to think about leaning into fixed income, I think, in an environment and really grab a hold of those yields.
What's insulated equities so far? Before we talk about that change in what's been working?
I mean, it's just sentiment. It's incredible just to see, the parts of the market, like we talked about earlier, that have done so well, looking at things like Bitcoin and small cap growth stocks and unprofitable companies. There's really kind of an everything is awesome mentality permeating the market right now on hopes of this, not only soft landing, but no landing, which isn't really a thing. Or we would never have economic cycles. So I think we need to remember that economic cycle analysis does matter. It just doesn't exist today.
I want to go back to what you said, that you think that you could see quality hang in there.
Yeah.
This really raises a conundrum for big tech, because that has been the quality and the earnings. And yet a lot of people say that those valuations are so inflated because of rate cuts being kind of baked in.
Yeah.
How vulnerable do you think they are if they're both quality, but also a little elevated?
Yeah, I think the entire market would be vulnerable, but we have to look for those pockets that may be more insulated. Because of the valuations, there's absolutely a challenge there. And I think we're kind of past the point of reasonable, especially on a few of those mega cap names. And again, that's a reason that we think diversifying into areas that are actually cheap, which, by the way, the rest of the market's pretty cheap. And could be cushioned. It's kind of like, falling off a lower part of the staircase rather than from the top.
6 minutes away from that economic data. Mike McKee, let's talk about it. What are you looking for?
Well, we're looking for a slight increase, as we saw with CPI and PPI, but for slightly different reasons. And that may play into what happens. It's interesting what Ira said about the market going up, or at least bond yields going up, if we see a bad print, because that could help bring inflation down. One of the funny things about the PCE numbers are that they are influenced, or have been in recent months, heavily by trading on Wall Street. Portfolio management rose 5% in the last PCE number because there's been so much trading that Wall Street's making a lot of money. I call it the pogo problem. If you remember the old comic, we have met the enemy and he is us.
So we have about 5 minutes and 15 seconds. Emily, as someone who trades, are you trading on this number? How are you going to do it?
No, I mean, we don't think about things on a short-term basis like that. Over a longer-term basis, we're positioned. You all know we've been leaning into bonds here. Every backup in yields here we'll be looking at as an opportunity just to grab a hold of that income. And even if we see some chop in rates here today or over the next couple of months, I think the fact that we now have income in bonds and we can kind of add that back in, even if there's a potential challenge on the duration front, to us, that makes the asset class very attractive.
Emily, love this. It's good to see you in person, which I think is the first time in a long time, right? I can't believe that. We caught up with each other every month for 4 years. I can't remember the last time I've seen you. Maybe it was 4 years ago.
I think so.
Mental. Emily, it's good to see you.
Great to
catch up. Thank you. Emily Rowland, Michael McKee is going to be sticking with us as he breaks down that economic data in just a moment. Going into all of that, equity futures on the S&P 500 shaping up as follows. The S&P 500 negative by 1/3%. The data point, PCE, core deflator, month over month, the estimate 0.4%. Nil data, Renmac, breaking it down too. That's all next. This is Bloomberg. Economic data 20 seconds away. Michael McKee is going to break that down. Renmac's Neil Dutta is going to respond. Going into it, the scores look like this on the S&P 500. Equity futures down 1/3% on the S&P. On the Nasdaq also down 1/3% in the bond market. Switch at the board, a 2-year, 10-year, 30-year, 2-year yields higher by 5 basis points, just short of 470, 468.91. With your economic data, it's Mike McKee.
Anybody want to know what's happening with PCE? Got to wait just a moment. It hasn't dropped yet. The computers are all being attacked by people on Wall Street. But I can tell you, initial jobless claims move a little bit. 215,000. It was 201 last week in the revised numbers. And here come the income and spending numbers. Income up 1%. significantly higher than anticipated. It was a 0.4 gain anticipated by economists. Personal spending comes in as anticipated, up 0.2. Now the numbers everybody's been waiting for. The winners are PCE deflator up 0.3 as forecast. The PCE deflator year over year up 2.4%, which is basically just math. That's no surprise. The core comes in as forecast, double last month at 0.4, and the core deflator is up 2.8%, which is going to be a little bit of good news. That was what was forecast, but there was some fear that it would get pushed up to 2.9%, same as last month. And I can tell you the core for last month was revised down to 0.1 from 0.2. So it does look like at this point we're seeing a little bit less of the bad inflation news that we saw in the CPI, but we'll have to take it apart to get the full data.
I can tell you so far, Mike, the winners are the economists on Wall Street. Bank in line with estimates. Mike McKee, let's work through this price action. Equity futures totally unchanged on the S&P now. We inflected a little bit higher on the Nasdaq, now positive by 0.2%. The Russell up by a third. In the bond market, yields were up by 4 or 5 basis points at the front end, now up by just a single basis point on a 2-year at 4.65. On a 10-year, up by a single basis point to 4.27. In foreign exchange, euro stronger, dollar a little bit weaker, 108.45, Lisa, on the euro against the dollar.
You know, I'm looking at some of these numbers, and I have to say that they're all pretty much bang in line except for one, and that's personal income. And that comes in with the biggest gain since January 2023. Now, you either dismiss this as irrelevant or a fat finger, or you start to say, well, people are earning the money to keep spending, and that can keep this going for a longer period of time. So to me, that's interesting. Otherwise, all the numbers, yeah, you're right. It's pretty much.
Or you just turn to Mike McKee and say, Mike McKee, what on earth was that? What is that?
Well, we have to look, and I haven't got the breakdown of income yet, but we have seen fairly strong wages. And so that's what I'm trying to figure out here is where is this coming from? It is also January when we get usually get some additional transfer payments from the government into people's bank accounts. So that may be it. But give me just a second here, and we will find the answer.
You take a beat, Mike. I know Neil Dutta of Renmark is itching to get into the conversation. Neil, what do you see?
Well, I haven't seen anything. There's no Bloomberg terminal.
It sounded like you were itching to get in, Neil. Give me something.
I wouldn't be surprised, Mike, if there was maybe some upward momentum behind dividend income in the over the month. I mean, didn't Meta announce a huge? Wasn't that a big shock for everyone that they announced a big, dividend payment? And maybe that showed up in dividends, which drove the outsized gain in income.
But this is what we were just hearing from Emily, right, Roland? And this is what we were hearing from Mike, that basically traders are basically skewing some of these types of these numbers. Not, okay, you look skeptical, but basically changing the scenario because of the earnings that you get on Wall Street isn't typically what people think of when they think of income from going to a job and getting a wage gain. Does it matter from an economic perspective, Neil?
Well, and I think there's a lower propensity to spend out of stock market wealth than wages and salaries. But, the numbers are what they are. And, to me, what's important is that disposable incomes net of transfers are moving up and to the right. And that very much mitigates the risk of recession.
We do have a winner. I have the numbers on personal income now. So give Neil his stuffed bear. He hit the nail on the head. Dividend income up 4.1% in January. It had fallen 0.2% in December. So a big swing there. Wages and salaries up 0.4. That's a little bit lower than the 0.5 in December. And also transfer payments up 2.6%. So I finished second in this.
I want a stuffed bull, Mike. You know me better. Not a stuffed bear.
No bears, stuffed bull.
Neil wins as well. Neil, consensus wins this morning, kind of, with the exception of personal income. You wrote a note earlier this week, consensus needs to wake up. Now, let's push aside this one. Why do you think consensus needs to wake up? What on specifically?
Well, I think, in my view, what's happening is, number one, I think the consensus continues to revise up growth. Now, people are doing that. If you look at Blue Chip, the Bloomberg News consensus, I think GDP expectations have been moving up over the last number of months, which makes sense because the data has generally been better. But I do think that there's still a lot of currency in the long and variable lag idea. So when you look at people kind of mark to market the first quarter. Okay, that's going to be strong, but there's still a big slowdown expected in the next quarter. So there's this idea that any day now it's just going to kick in and there's going to be this weakness. And I just think there's only so long you can keep doing that. And that's why I think the consensus has been sort of perpetually surprised to the upside. We are seeing a upturn in cyclical manufacturing. for example. So I do think it's unlikely that growth is going to slow down meaningfully between now and the second quarter. But I think what the consensus has lost a little sight of is inflation. Yes, January was a setback, I think, but to me, the overall story is still the same, which is we have a period of disinflation in front of us. When I look at things like the employment cost index and the quits rate, the inflationary impulse from the labor markets are fading, and we also know that productivity is picking up. So unit labor costs have come under some control. And so to me, that kind of sets the table for the direction of inflation. So yeah, January was a bad month, but talk to me in the spring. I wouldn't be surprised to see things like March, April core inflation come in weaker than expected.
You said at the end of last year, I remember the line, and you were right, the Federal Reserve started echoing that view. The labour market is no longer a reason for this Fed to be hawkish. That certainly seems to be the way they see things now. So what do you think is holding them back from reducing interest rates? What do you think they're concerned about?
Part of me thinks that they were surprised at how quickly inflation was falling in the back half of last year. I mean, if you told someone that 6-month annualized inflation in December of 2023 would be below 2%, if you told them that in the middle of last year, they would have been very surprised. But that's exactly what happened. So I almost feel like they didn't set the table to kind of communicate March. And frankly, I mean, even the last statement, it's basically a hodgepodge of language just to kind of, I think, get some of the hawks on board to kind of lay the groundwork for a cut. So, my sense is that the May probabilities in the market are somewhat underpriced. I think the markets, as I looked at them, what's like 10-15% chance for a May cut. I think as the inflation data come in over the spring or March, April, I think those probabilities may rise.
So you can hold your bull stuffed animal, and I'm just going to hold the bear stuffed animal for a second.
Shocking.
I know it's going to shock you, but I'm listening to you talk about the disinflation and how it was a blip. But then how much of this is just entirely commodity driven, right? How much of this is actually not that people are paying, that people aren't shelling out more when they go to a restaurant and they make, get omelets with some secret ingredient from IHOP? There is this feeling that there is some sort of sustainability in the services inflation. How do you not see that coming to the fore if we get, say, higher gasoline prices?
Well, it's interesting you mentioned higher gasoline prices, but obviously natural gas prices are down quite substantially, and we know that that's going to bleed into household utility bills too. So it's sort of a give and a take. We know that agricultural commodity prices are down. You're probably going to mention chocolate, but but when you look at the broad range of agricultural commodities, they're down. And that's going to bleed into what people pay at the grocery stores. But I think whenever you have things like this, it's important to kind of go back to first principles, right? And what do we know? Inflation expectations are down. The Conference Board data came out yesterday. 12-month inflation expectations are down. Longer run inflation expectations and short run inflation expectations for firms are down. That's from the Atlanta Fed's Business Inflation Survey. And ultimately, compensation growth equals inflation and productivity. So if compensation is running 3.5–4% and productivity is running 2%, we're there. So, that's sort of how I'm thinking about it.
So I know that you also send out emails saying, like, everybody needs to wake up because this is a good economy and everyone needs to get on board. It looks like they're on board. What do you think they're doing in the equity market? How much more can you lean in after what we've seen?
In my experience, Lisa, momentum is an important driver of equity markets. So I wouldn't, people talk about valuation and things like that, but there's no safety in low multiples. And, valuation's a very poor timing tool. So if everyone's saying it's gone up a lot, that means it can't keep going up. Usually in my experience, that means that it can keep going up.
Are you a May guy then? You're looking for that first cut in May?
I'm generally on the side that inflation is still slowing, and I think it's probably slowing more than the consensus thinks, so that leaves me in a position where I believe that they'll go a little bit sooner. Now, things could be sloppy. There could be some residual seasonality in February, but again, it's about first principles.
Yeah.
Inflation expectations, if you survey households, they're going down. So... And as I mentioned, the labor markets are in much more balance. So I think those two things give me confidence that a lot of this, setback that we've seen on inflation after several months where it's been coming in better is probably just that, just a temporary
Do you think
setback.
we see a little bit of this, sort of like they drop rates, but the long dot has to come up? Do we see a bit of that this year?
I think if the economy is growing the way I think it is, the likelihood is that all you can really expect is a recalibration of policy. And, one way they could potentially signal that neutral is higher is by taking away some of the cuts that they have in place in 2025.
Let's talk about chocolate. So I was looking, actually, there's a Business Week story about chocolate and how chocolate makers are actually using less chocolate because it's gotten so expensive. And yes, part of this is droughts and things of that nature. But there's also a question of policy and certain ways that people want to...
Protectionist European policy.
Well, you want to say this, whatever. But
sure.
I want to bring up, policy and how that's going to really factor into this inflationary outlook. If we do start getting tariffs, if we do start getting protectionism, if we do start saying, for example, that Chinese auto manufacturers can't come here and that, other people can't too for national security reasons. I mean, does that factor into inflation for you?
I mean, it does, but think about what would happen if they started announcing a lot of tariffs, right? I mean, would that be inflationary? Yes, but it would also be negative for growth. I mean, that would probably be, you'd see financial conditions probably tighten because the stock market would drop. I mean, we saw that play out in the previous administration. So, tariffs are inflationary. What did the Fed end up doing? They offset some of Trump's trade war by cutting interest rates.
Well, what are your domestic and geopolitical concerns then? It feels like you have none.
I'm not a geopolitical person. I think that I just sort of take that as a given. It's something that everyone always talks about whenever the economy's going well. Oh, geopolitics could send oil prices up.
Well, there's two hot wars, though. And we have the Houthis regularly hitting vessels in the Red Sea. At some point, does that never come into your thesis of a concern?
It does, but I think at the same time, corporate profit margins are somewhat higher. So the fact that supply chain disruptions have gone up potentially. I mean, it could lead to a situation where maybe firms are a little bit more willing to not pass those prices on because their margins are somewhat higher. This is not the same situation as it was, a year and a half ago. So I do think in the aggregate, supply chains are in a much better place. Everyone kind of knows me, Annmarie. I do think that there are always risks, but I tend to kind of think that things have a way of working themselves out.
And they often do. Neil, it's good to see you, as always. Neil Dutta of RenMac, breaking that down for you. On Wall Street, in line is the new beat when it comes to inflation, or rather in line is the new downside surprise. Equity futures right now positive by 0.25% on the S&P 500. Just to give you a flavour of the bond market as well, yields are up at the front end by 4 or 5 basis points. Now positive just 2 at 466. If you look at foreign exchange, dollar a touch weaker against the euro off the back of the numbers, but on the session, that currency pair still negative on the day by close to 0.06%. Outperformance on the Russell, the small caps you would have seen there going into the opening bow. More on that in just a moment. Let's get you an update on stories elsewhere. Here's your Bloomberg Brief with Danny Berger. Hey, Danny.
Hey, John. Shares of Paramount are up in the pre-market. The company predicted, quote, significant earnings growth this year. It helped investors overlook a 6% sales drop. There is shrinking ad revenue on traditional TV channels that contributed to that. The company said subscriber growth beat estimates on its Paramount Plus streaming service, which it does expect to be profitable domestically next year. An Illinois judge has barred Donald Trump from appearing on the primary ballot. It's the third state to impose it for Trump's role in the January 6th insurrection. He has until Friday to appeal and is already appealing a similar ruling from Colorado before the U.S. Supreme Court. Another partial government shutdown is a step closer to being averted. Congressional leaders struck a last-minute deal to provide one more week of funding after the Saturday deadline. It keeps parts of the government funded through the end of September. But other agencies, including the Defense and Homeland Security departments, would still face a shutdown deadline of March 23rd. Speaker Mike Johnson plans to bring the one-week extension to the House floor today. That's your Bloomberg Brief. John.
Danny, thank you. They're coming after the chocolate. You see that?
That was just
even come up in that conversation. They're coming after the chocolate. They just want you to be miserable.
No, the fact that they're using less chocolate in the recipes at Mars and other things.
See?
What are you buying then?
They're coming after the chocolate. You're on
I
board.
like your chocolate.
Up next, President Biden turning up the pressure on Chinese EVs.
When you look at the intense price competition that you're seeing in China right now, that's not sustainable for any company. And so we're positioning for where GM has to be to compete in a very different market.
We'll talk about that very different market up next. Live from New York, this is Bloomberg. In line is the new beat on Wall Street, that's for sure. PCE, core deflator, coming in at 0.4%. The estimate, 0.4%. The previous month revised lower. Equities up Up a third of 1% on the S&P, and the Nasdaq higher by 0.6. Outperformance on the Russell to small caps. Rate sensitive, up by 1.45%. Let's look at rates. 2-year, 10-year, 30-year in the bond market. Treasuries yields were higher by 4 or 5 basis points at the front end. Now up just a single basis point on a 2-year. 464.98 on a 10-year, unchanged at 426.78. Under surveillance this morning, President Biden turning up the pressure on Chinese EVs.
When you look at the, the intense price competition that you're seeing in China right now, that's not sustainable for any company. And so we're positioning for where GM has to be to compete in a very different market. You do need a level playing field. And I believe with our portfolio in many of the markets we compete around the globe, if there's truly a level playing field, we have a strong portfolio and we're going to do well.
It's the latest this morning. The Biden administration calling for an investigation into Chinese EVs, warning of possible national security concerns. President Biden saying, quote, China is determined to dominate the future of the auto market, including by using unfair practices. China's policies could flood our market, posing risk to our national security. I'm not going to let that happen on my watch. Bloomberg's Craig Trudeau joins us now for more. Craig, here's the question then. So we've got tariffs already, 25% on Chinese EVs. You've got an extra 2.5% on imported foreign vehicles, so 27.5%. What next? Where are they going with this?
I think what we're learning is that, there's no losing in Washington right now in terms of, the race to be hawkish on China. I think it's the one thing that's sort of dividing everybody in Washington. And I do think that, the fact that the Chinese have come on so strong in just the last few years, where, BYD surpassed Tesla as the biggest EV maker globally last quarter. We've seen China overtake Japan as the world's biggest car exporter last year. I think the amount of fear both here in Europe and in the U.S. about this threat that the Chinese pose to, whether it's the U.S. car industry, Germany, France, Italy, everyone's very concerned about this and sensitive to it. And so I don't think that this will necessarily be, a sort of rare occurrence in the months and years to come.
Yeah, but Craig, define threat. Threat to the economy, to the national champions of this sector, or seriously a threat to national security? Which one is it?
I think maybe all of the above. I mean, even Elon Musk, who, is never one to shy away from, talking a big game, is, just in the last few weeks talking about this idea that, the Chinese are their most intense, and serious competition. And Elon Musk talking about the idea that unless trade barriers are put up, that the Chinese will, beat up on the rest of the industry. I think, he would like to think that Tesla is, very, very much primed to compete. And I think, of course, on a global stage, Tesla is still, very, high up there in terms of leadership. But, even Ford recently, too, talked about, the amount of market share that each of these companies have at risk as a result of the fact that the Chinese are just so much better on cost and so much, out in front of the rest of the world in terms of, lowering battery prices and being able to offer EVs that are actually price competitive relative to combustion engine cars.
We see China trying to make a massive inroad in Mexico. Is there a way they could circumvent what the United States has on the books now?
I think that may be a big part of why we're seeing this latest action that was formally announced this morning is basically trying to slam that back door shut. To the extent that that was potentially a path that a company like BYD was looking at as a way for them to get around tariffs on Chinese imports. Mexico, of course, has a free trade agreement where perhaps there may have been an opening there. If we see the U.S. look at Chinese vehicles on national security grounds, it would sort of be a way to get around the fact that a company like a BYD is looking at Mexico, is building a plant in Hungary as well, and just globally really sort of setting up all over the place to move beyond just being a major player in its home market.
China, we've seen in the past, have export controls when it comes to raw material processing technologies, which the GMs, the Stellantis, the Teslas will need if they want to make their own batteries. Do you think we could see a tit-for-tat response from China if the U.S. was to take this in a more aggressive direction?
I think that's absolutely something that the industry worries about, and we saw that, sort of come to pass just in the last few months when the European Union started taking a look at China's subsidizing of its auto industry. You saw, some moves on, gallium and graphite, and various ways that sort of on the margins, China seemed to be sort of sending a message of it would be a shame if you were to crack down on us because look at all of these ways that we control the supply chain, and if we were to turn the screws, it would make the transition all the more difficult for the U.S. and European car makers that have really struggled with gaining traction in this transition. Aside from Tesla, a lot of these companies outside of China have talked a big game, but really not been able to sort of get traction with scaling up their EV and battery business. Whether you want to talk about Volkswagen or General Motors or Ford, these companies set very high targets, big ambitions, but really have not hit the mark yet.
Craig, we're talking about electric vehicles and the U.S. auto manufacturers competing, but there was never the word electric vehicles or the phrase put into this letter, the statement from President Biden. He was talking about connected cars. He was talking about the importance of the big three to the American economy and dynamism of the outgrowth of auto manufacturing. He was talking about protecting U.S. jobs. What is the ultimate goal here in terms of U.S. support for the big three in Detroit?
Yeah, I think that's a really good question, and I would go back to this idea of this tit for tat. And if we want to actually pan back a little bit and think about what China has done even just in the last couple of years, the fact that electric vehicles increasingly are connected devices with cameras in them. Just in the last couple of years, you saw actions taken in China to prevent Teslas from being around military bases in China. So the fact is, this has been a concern that didn't just start this morning in Washington. It's something that governments have looked at closely, and I think it's absolutely perhaps a sort of novel way to look at the ways to protect your market for an industry that's so important that provides so many jobs for people and good paying jobs. This is about industrial bases that economies have looked to protect for many years and will for years to come as we make this transition to EVs.
Hey, Craig, good to hear from you. Craig Trudeau of Bloomberg over in London. Bramo, we can see where this is going. This is going to become ultimately a state-sponsored industry. If you want to make that transition, and this administration is desperate to make that transition, they have to sponsor it themselves. Provide a bunch of incentives, subsidies to do that. Do they want to do that and have a foreign manufacturer benefit from it? A foreign manufacturer with a massive cost advantage, and that's before we even get into national security issues as well. If you want these three to thrive in Detroit, you've got to put the walls up. Everyone's been saying that for a while. The walls are going up.
But we also have to figure out what the technology is that's essentially going to be the new car of the future, because that's still in the works in terms of tweaking around the edges. As you were talking, I'm thinking this is such a complicated thing to achieve, to put the walls up and to have a successful industry. I want to see an actual comprehensive plan to understand all the implications.
I'm looking through this statement again, and all I could think is this feels like it could be a blurb out of Lighthizer new book. China imposes restrictions on American autos. Why should connected vehicles from China be allowed to operate in the United States? Whether or not you get Trump or Biden, this is the direction of travel.
There's not much daylight. That's for sure. Coming up tomorrow, we'll catch up with Citi Steve Whiting, Avery Sheffield of Vantage Rock, Megan Robson of BNP Paribas, and Lara Rame of FS Investments. Live from New York City this morning. Equities doing nicely. No bad surprises coming from that inflation data. It's a rally going into the opening bell. The opening bell just around the corner. This was Bloomberg Surveillance.